I guess we call the formal meeting of the Board of Investments to order.
So you can do, why don't we do roll and then pause until 11:15 when we've noticed public comment and
Okay,
action items.
so Savannah, if you're there, can you see if any of us are awake?
I am here and I'm going to see if I'm awake. So let's all wish each other luck. Good morning. Here we go. Jack Prothero,
Here.
Cindy Youngkin,
Here.
Porter Bennett, absent,
Captain.
Tim Kober,
Present.
Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith,
Here.
Dan Trost,
Here.
Dwayne Iverson,
Here.
and Senator Jeremy Trebas. Not here. All right, we have a quorum. Thank you, Mr. Chair.
Okay, thanks, Savannah. So as Dan had just mentioned, we'll proceed in a little different order than our schedule. So from here, we'll skip the rest of tab 1 and go directly to tab 2 and then circle back to tab 1 at 11:15. So Dan, tab 2.
All right, you have the monthly snapshot. You'll see we crossed 27 billion for the first time ever last year.
Getting down to real money now.
Yeah,
That was
that's why you got your per diem bump from the legislature. They were preemptively proud. It won't be that high for a while again. There's gonna be a lot of cash flowing out from STIP, income tax rebates, property tax rebates, capital outlay, debt payments from the state. So it'll be a big move in STIP, but we're on top of it. Kudos to fixed income, coordinating with Department of Revenue and Department of Admin to facilitate that timing. You have the budget status for the prior fiscal year. We were able to exceed last year's dividend. We paid 1.55 million back to our participants based on additional efficiency savings, the rest. So cost containment's working. Any questions on the budget?
Not so much on last year's budget, but the budget going forward. You want to talk about that for a second?
So this year is the big payment for legislative audit, so that number of our expenses will be greater this year because of the audit. We didn't ask for a fee increase from the legislature, so basically the dividend will be our operating margin for the next several years. I don't anticipate us being in that 1.5 million number again as the pay plan kicks in. General inflation on our contracts. I mean, we had not that we can control it, but Bloomberg was up 10%. Not helpful, but we didn't want, our ceiling is set. Our ceiling is the same as it's been for the last 4 years. It will be the same for the next 2. It'll be the dividend that becomes the squish. Any other questions on the budget?
Mark, you are always worried about budgets.
I don't have any questions on the budget.
If not, the 2024-2025 work plan and draft meeting calendar is there, so we can preemptively ruin your lives several years out. Only the 2024 dates are built in. Purely from a selfish perspective, your quarterly meetings are scheduled around when my son is with his mother. Other than that, those are the dates that align for us to have the information and be able to scrub it for the reporting. The April and October meetings, 1-dayers, my goal moving forward is to try to get that November, December meeting down to 1 day. I think that'll depend a lot on asset allocation, but for now, book it for 2, and if we can make a day, we'll make a day.
So Dwayne, just so you know the process, what we try to do over a 2-year period is make sure we go over every sort of line of business So we can do a deep dive in those. And so it's a 2-year process, and you'll notice if you look at how it works, we hit all the highlights of those in the 2 years. And so that's the goal, is to make sure we all look at that deeply on a 2-year rolling.
So there's, this is just FYI, we'll ask for a vote on it later. If there's other items you'd like to add to the work plan, please feel free. If there's things that you think could be combined, streamlined, let me know. But we have the recipe, putting it back in front of you. If you find some different flavors you'd like on it, great, we'll build that in now and be ready to go.
Is there any, I'm always worried about risk, as you know. Is there anything that is more risky than normal or higher risk that we should make sure we cover, just as the lens looking at risk to the board?
So not on this, but we'll talk about the October board retreat with RVK. We've done an offsite for the past several years with all the board members, looking at going to Boise this year, to their Boise office at some point in October, November for all of you. I think that would be a great time for the board and John and I to chat through that exact topic. I can see the loan portfolio is a lot more active. The state is putting a lot more resources with us there. Do we need to bulk up systems wise, things of that nature? But looking, so both on a calendar and a risk perspective, that's the time to look at it, but also we should talk about if you all have dates in October that don't work, October, November, if you could send those to me. We'll try to get a 1 day down in Boise at RVK's offices there.
So is that, how formal is that? Is there potential for a Zoom meeting tonight?
It's your meeting. This is your opportunity. I know we want to do the governance structure and board stuff that you brought to Becky. They've got some things to talk to all of you about with John and I not in the room as your consultant. And then John and I will come back after you're all well fed and the AC's turned off to visit with you about issues you may have with
It's
that.
October, you think you need to worry about AC?
It's Boise, it's always hot.
No.
Do we do fiduciary training every year here?
Yes, Dan White does something.
He's kind of like.
Yep,
you know,
he's our
on the-
guy,
on the
yep.
board.
Mhm.
I
And
just
it's
don't see it
also-
anywhere, so.
It's also incorporated into the orientation packet. So yesterday, Dwayne came in for new board member orientation. We touched on all the elements of, Cardoza and the other pieces.
It just seems like it's something we should do
Okay.
regularly as a reminder of our.
There's only one thing you need to remember. It's not your money,
Yeah.
period.
Well,
Right, Dan?
kind of. She's got a little share of it.
It's got retirement account,
Yeah.
so do I.
Yeah,
It's so small, we don't even need to worry about much.
you're immaterial to put it in an audit
Really.
perspective. So that's all I have, Mr. Chairman.
Okay, any questions for Dan at all?
Is that our EK meeting? Is it generally midweek or do we try to,
We'll go around you guys.
whatever?
So if everybody would just get me some dates that don't work or that work better than others, we'll coordinate and try to get out. John has a big due diligence trip in October, so we'll try to work. Yeah, so
And so really, it's almost a drive. You can fly there easily.
oh yeah, you can fly there. I mean, I don't know if do you guys know Bob Green? You two know Bob Green. Bob Green was the coach at Montana Tech for years, and he's stone cold deaf and yells everything and has some of the best one-liners ever. And his latest one-liner is, I don't know if I'm going to heaven or hell, but I know leaving Butte, I'm going through Salt Lake first. So yeah, we can fly into Boise.
Well, you can't, there's no place in Montana you can get to it from except through Salt Lake or
Yep,
Denver.
Salt
maybe.
Lake, Denver's,
You could go to
Seattle.
Seattle if you want.
yeah. So I think,
It's really the long way around.
anyway,
So does this replace our regular scheduled board
no,
meeting?
this is sort of the board training, team building meeting that you did a few years ago in Portland.
When we went to Portland, okay.
It just, they have got an office in Boise. Why go to Portland when you can go to Boise?
And Paige, who does a lot on our account.
She's in Sun Valley, so.
Well, then why don't we go to Sun Valley?
Now, there's an idea.
Just
Just
saying.
saying.
Maybe we could
Right
meet
around
with-
Christmas week, that's how we get the auditors looking at us.
Well, October's fine. The aspens are on fire in October. So.
All right.
Okay. That's anything else for Dan? I think we're done with tab 2. Let's go to tab 3. Doug, you're back on.
Good morning again. So the review of the commercial and residential loan portfolios. The participation loan program reflected an outstanding balance as of June 30th of almost 92 million. It was 42 loans and the yield in that portfolio is 2.56%. Currently, we have 4 loan reservations that total a little over 16.6 million, which we just approved 3 of them. And we had 7 committed loans for a little over 16 million. And there's no past due loans in that participation portfolio. There's really no past due loans in any of the commercial portfolios. Infrastructure loan program had a balance as of June 30th of a little under 10 million. It was 8 loans and the yield on that is 4.07%. We do have 1 loan reservation for a little over 2.7 million. The intermediary relending program has an outstanding balance of a little over 5 million. It's 38 loans and the yield on that is 2%. We've got 2 committed loans at 487,630. Science and tech portfolio had a balance of a little over 7 million. It's 2 loans and the yield in that portfolio is 2.89%. The Montana Facility Finance Authority had an outstanding balance of a little over 10 million. It's 15 loans. The yield on that portfolio is 2.55%. They have 1 reservation for 1.5 million. The Veterans Home Loan Mortgage program had a balance of a little over 49 million. It's 278 loans and the yield on that is a portfolio is 1.88%. They had 2 loan reservations of a little over 500,000. There were 2 loans over 90 days past due, totaling a little under 300,000 or 0.059% of the portfolio. The multifamily Coal Trust Home Program had a balance of a little over 11 million. That's 6 loans and the yield is 2.32%. They've got 2 reservations that total a little over 3 million. No past due loans there. The allocation for this program increased from 15 million to 65 million on July 1st. And then the residential loan portfolio had a balance of a little over 1.3 million. It's 39 loans. The return is 6.31%. We have no outstanding reservations. There are 3 loans over 90 days past due, totaling a little over 100,000 or 8.83% of the portfolio. Those loans do have FHA guarantees on them, so we're at no risk of loss of principal on that. And then the down payment assistance program had a balance of a little over 27 million. It's 53 loans. There's 43 loans committed that total a little over 25 million. So any questions on any of those? Yes.
On the ones that are past due, how do they eventually, or do you anticipate those eventually will move into foreclosure?
Well, they are in the foreclosure process, but I don't think they will make it to the foreclosure date. I think you may remember from the last meeting, we have one borrower that's been in foreclosure about 15 times.
You
So
just bring it current right up at the last minute.
it's doubtful, but if I wouldn't think so because they've got so much equity in those properties. This is a very old established portfolio of loans. We have not made a loan in this program since 2010. And the reason being is the funds for this come from the retirement plan. And when the retirement plan's return exceeded our, what we want and where the market went, you know, during 2010 going forward, we haven't done anything in that program. So it's, if they do go into foreclosure, then we just go to FHA to pay the guarantee, so.
Any other questions? Doug, I always like to get from you a general feel with your calls and what you think is happening in the economy with your banking customers.
Yeah, so there's still activity going out there. I think the summer months are kind of slow for the banking industry. So activity has gone down. I'm sure interest rates have impacted the demand for loans. As you can see from participation loans that we just reviewed and approved, the lenders' rates are much higher than they were, you know, a year or two ago. So, you know, that has an impact, but there is activity, maybe not quite as much as it has been.
What's prime? Didn't it just go up?
I really don't follow prime.
It's 8.5, yeah.
8.5.
They hiked it on July 26th was the last move.
8.5. Got pretty spoiled with that 3.5.
Yeah, the real estate rates have gone to like 7%. I have quite a bit of history and experience in the banking world, and when I started in banking, the rates were double digits. When I became a
You're dating
residential,
yourself.
lender, when I was looking at a home, the rates were around 9%. Rates went 8%, down to 8% in the range for about 2 days or 3 days. I thought that is the last time we will ever see rates at 8%. This is 1991. And boy, was I wrong. But, you know, rates are higher. They're lower than they were. But I think the problem is that the price of homes are so much higher than they were in 1991. But it's definitely impacting the lending world.
What are you in debt? Anything else for Doug? Thank you, Doug. Louise? Tab 4.
Thank you, Mr. Chairman, members of the board. So under tab 4, you're looking at the InterCap program, fourth quarter activity summary, something that we do every quarter and you're very familiar with, but perhaps for the new member, I'll just go through that a little bit so they kind of can follow what we got here. So on that top left-hand side is the bond series that we spoke about yesterday, that the STIP program has in its holdings. The outstanding on that is 68.7, but we can draw on that up to 51 million, so that up to that 120. So that's why we track that, just to see how much we have available. We also, on the right-hand side is the loans outstanding side. So as of 6/30, we were at 68.6, so very close. And that really tracks pretty close, the bonds outstanding and the loans outstanding, which is good. That was the reason why we did that change. Another thing is, if it does, those loans outstanding do drop a little bit under that bonds outstanding, then we have that cash is sitting in STIP, and STIP right now is doing better than what we are paying for that bond rate. So we're bouncing along pretty good with the InterCap program. Below that, you're going to see the commitments and funding for the fiscal year, and then you have the comparison for over 5 years there. We do track the variable rate loan history towards the bottom, and you can see that we were going very low interest rates for many years, but now we're climbing back up into those delightful 80s era. I think it was when I graduated from high school, the highest this program ever was 7.95%. It was in 1989. Doesn't seem that long ago, does it?
No.
Yeah, seems like just yesterday.
What year were you born, Dan?
83?
He was in junior high.
Louise, what percent of our borrowers are set up with auto pay?
We have about a little over 70% now.
70%?
Yep. So we're getting closer to that goal.
I just can't imagine what that percentage difference was.
That higher rate, the 1/4% that we put on there really jarred them loose as to getting that flipped over.
Next year, I'm gonna ask for a little bit more, just to keep tightening that down. It's
What's the goal?
get everybody to
Yeah,
ACH.
100%.
Nice.
Why wouldn't somebody do it? What's the reason?
Cash flow.
It's just old school. Yeah.
How so?
Some people still like to write the checks.
We like to time the checks.
Well, the
like
checks
even-
are due August 15th, so
But even like in hotels, even though they're not in part of this, we see that cash flow, and there are certain times of the year where you hold it to the last second, you know? But even ACH, you could set it up.
yeah, we set it up. It's due the 15th. We pull it the 15th, so it's
You plan for it. I can't understand why they wouldn't do it, so.
So another percentage, there's about 80% of those that are auto pay are part of that or the loans outstanding that you see. So were there any questions on that activity summary? Okay, let's go to the staff approved list. This is what we have approved as a staff between April and June. We only had one new borrower, and that was Sheridan Rural Fire District. So they were brand new to the program. Everyone else is just a repeat borrower with their different projects. So were there any questions on the staff approved? Okay, so just a little bit more as to where we are right now. We haven't had to change that dollar amount on that STIP bond yet. So bond series 2022 has stated that amount since we put it in play in January 2022. The principal that we were expecting for the 815, we got 5.3 million. 3.8 of that is principal. We have 1.8 of that already scheduled to go out into fundings by the end of the month. So the outstanding after that is applied is about 68.2. So again, we're still tracking with what the bonds outstanding are. We have about 10 borrowers we're going to do a follow-up on. With local government, it's a little bit different with timing. So say a clerk forgets the payment or something like that. It takes a little bit longer for them to correct that. So for them to get their meetings and get their approvals and all that. So some of these that are lagging behind, we'll have those cleaned up probably by mid-September. Not a big deal. Not worried about that at all. So once a year, we'll switch to the memo as the annual detail report that we provide. So just kind of a general who's out there right now as of June 30, the commitments that we have, the outstanding that we have. This little memo ahead of this shows the comparison between the 2 years. So that you see the number of borrowers are dropping a bit. So we have, the year before was 143 borrowers. We dropped to 133. Now we have, and once again, though, the bonds outstanding and the loans outstanding, that is tracking really close. And the difference, if we do drop below that, is waiting and stiff. So we're not losing any money there. Were there any questions on the activity memo?
I know it's well diversified and that's a good thing. We do have some limits on like the universities and things, so.
Yes, we
keep
do.
that in place, right?
Yes, we do. The universities is 19% of the bonds outstanding. And transportation, we have a cap for them for 10 million. And usually with like DNRC, you have transportation, those are really rotating. As they're paying out, they're loading more on. Interesting with GNRC is that they've, when everything paid off this year, it was the big payoff. They loaded it right back up with commitments. So they're just as busy with the infrastructure projects, and they like to use us as interim. So
Just because of backlogs? Stuff they've
just-
had on their list that no one.
just ones that they already have commitments for and that they're going to need money for in the future. Yeah, so they really like to use us because they can use the repayments that are coming in to pay us off instead of actually issuing a bond and going through that whole process. It's an expensive process to issue bonds. So this way they can use our bond anticipation note, pay us off, and they don't have to go through that.
So is the DNRC must just be roads on state lands?
No, DNRC, actually, they're the ones who administer for the DEQ, the state revolving funds.
Oh.
So this is the infrastructure stuff. This is the water, the wastewater, millions and millions of dollars. They're a pretty big animal.
I think House Bill 6, 7, and 8.
Don't think of that.
That was the first thing that came to her mind, I think.
Yeah, no, she
It
was like,
was really.
All right, so any questions on the memo? Okay. So just, the next one is the detail report of just who's out there. We did have 6 new borrowers this fiscal year. They were schools and fire districts. Just to touch a little bit on the activity in York County, I know that we have some members here in the Cascade area. No new loans in that area, so not much really to bang the drum about. In Cascade, most of the activity ended up in member Meredith's port there in Flathead. We had, looks like we had 5 or 6 new, let's see, we have 1, 2, 3, 4, 5. We had 5 new loans there. 2 of those were brand new, and they were rural fire districts in Evergreen and Ferndale rural fire. One interesting thing, I was talking to the fire district folks, and they said one thing that's gonna start holding them back is the cost of the trucks. All the costs are going up for how much these vehicles are costing now, and it's starting to exceed their budgets.
Like $1 million, aren't they?
Yeah, exactly. So we may see a little fall off in that area too. There, the loan might be for a new engine.
Or new pumps.
Or a paint job or something like that, but yeah, I think a lot of these smaller rural fire districts are going to tighten their budgets a little bit coming ahead.
So the longest you got is 15 years?
Yes, that's our maximum. Or useful life of the project.
Okay.
So when it comes to, say, like a police vehicle, we would do those for about 5 years because they run those ragged, right? So fire truck, hopefully they're just sitting in the fire station waiting, getting rubbed down and babied. So we do a new one, we'll give about a 10-year. All right, so who's next here? Golden Valley was a new borrower, and also one of the ones that we were waiting to actually borrow out of. And let's see, we have Lewis and Clark County, we just had a couple of them. They're really using us a lot for rural improvement district bonds. So all these roads that are being done around here in the county, that's who they're financing them through. So we have some activity in the Madison County area. One was the Sheridan Rural Fire, and also we had Yellowstone Mountain Club Rural Fire District. And those folks, right when we got their big loan done, one of the ambulances that they had blew an engine. So then they had to come to us for another loan to get that ambulance done too. So I think that's pretty much, nothing in Butte Silverville. You won't mention any names.
we don't pay for things with loans.
Or cash only,
Yeah.
cash and carry.
That's a requirement.
It's not our choice, is it?
So, I have a question. So I'm looking at some of these police vehicles.
Mhm.
So some are for 3 years, some are for 6 years. Is that based on what
Those are really what they're requesting.
they're requesting? That's what I was.
Yeah, so it's what they're requesting, or if it is, they can do like less than. So you see the 6-year one? Yeah, with the prices going up, I might be leaning a little more into longer terms.
But there's no prepayment penalty,
No, there's not.
so
Yeah,
they can
so
go
that's-
5 years and still pay it off in 3 years.
And there are some times when they want to pay it off early, but it doesn't work out for like the credit analysis. So I suggest to them, let's set it up with a longer term, stretch that debt service, so you have that buffer there, but you can pay it off without penalty. And that works out pretty good too.
Do they have any closing costs or they just start paying interest?
Just interest.
Yeah.
Yep. And it's on what they draw. So we only release funds on what they have invoices for.
I like this report.
Well, this is the once a year, yay, intercap.
So any other questions for Louise? Just in general, what do you see in the environment, the economic environment you're working in?
You know, I'm going to echo Doug. The interest rates are going up, prices are going up. It's going to very likely affect everyone's budgets, but things still need to get done. So I think we're going to see some loans. There's going to be some people out there that in their committees and whatnot, they're going to do the best they can for their taxpayers. So, you know, whatever services need to be focused on, they're going to borrow for those and, you know, let the frivolous ones pass on until they can get to it. So
So Louise, I saw that Western is building a stadium or something. Are they not?
I haven't seen anything from Western.
There's a pipe dream.
Oh, they're building it. They broke ground. I was just curious if they were
I don't know if that's a
financing
good
it.
credit.
What?
I don't know if that's a good credit.
Still the normal?
Yeah. If they want a new screen at Tech, we'll talk, but.
So we have done the program agreements for the universities. We have updated those. So UM is back in. When they paid everything off in October, a few years back, that negated that program agreement, so we have re-upped that. They haven't come into us for a new loan yet, but eventually they will. MSU Bozeman, they are actively, let's see, Bozeman, no. Billings is actively borrowing. Bozeman has outstanding that they're just repaying.
Okay,
All right.
Thank you.
thank you.
Well, thank you very much. Have a good meeting.
I think we can go to tab 5.
We can go to tab 5. We may, in a transition period at 11:15, do 5 minutes of administrative stuff and then let you guys keep going. So we're gonna not only put you early, but we're gonna break your flow.
Let's roll with the punches.
So John, I appreciate you actually having a suit on today.
Thank you. Well, you know, the podium, it's very slimmy. I'm a fan.
Good to know.
So, thank you. Thank you, Mr. Chairman and members of the board. I'm John Ramosko, your Director of Fixed Income. With me here today is Kirsten Haswell, our Fixed Income Investment Officer. Sam Holman is one of our Fixed Income Investment Analysts, and Willie Gross is also one of our investment analysts. Kirsten's been with us for about 7 years. She had a background before that in wealth management. Sam has been with the board for about 3 years. She started, you might recall, she started as our intern deluxe, if you will, and then was put on full-time in accounting. And about 7 months ago, the fixed income team poached her. So also Willie Gross has been with us for about 3 months now. Before that, he worked in actuarial services. So this will be Sam and Willie's first time presenting in front of the board, and I had promised them that it was gonna be after lunch, it was gonna be hot, you're tired, you won't ask any questions, but please do ask any questions as we go. If I can refer the board to slide 3 of tab 5. This is a listing of all of the accounts that are in the trust fund investment pool. And I should note that this is just their investment in the trust fund investment pool. Many of these accounts have significant investments in STIP or other securities. So you can see the largest investments are in the
constitutionally mandated permanent funds such as the coal severance tax funds. All of those sub-funds add up to a little north of $1 billion or about a third of the 3 billion total. Additionally, you can see the constitutionally mandated school facilities, I should say, public school trusts, also constitutionally mandated. Also in the permanent fund are non-constitutionally mandated funds, but legislatively mandated funds. And so think noxious weeds and
Resource intensive.
So some things to note about those is that even though a fund can be constitutionally mandated, maybe the legislature will change those sub-funds and quite often does. And also the legislature can call a fund permanent, but that's only as good as until the next session. And we've had occasions where the legislature has created a permanent fund and then drawn it down. We don't, if the legislature says it's a permanent fund, that's how we manage it and don't second guess them. Next, in terms of size, there are the expendable trust funds. And over the years, these have been almost entirely for environmental damage settlements. Those funds are in fact expendable, but we think that they will be expendable over a period of many years, if not decades. And so we think of them as being an appropriate investment for the trust fund investment pool. You can see the operating funds of the various state agencies. There again, those are amounts that the client believes they won't be touching in any foreseeable future. And then finally, the smallest portion being the insurance reserve funds. And while that's the smallest portion, I would mention to the board that it does not include the Montana State Fund, which is about a $1.5 billion fund that is managed separately.
Question on so is there the abandoned mines and Zortman, are those just not funded right now? They've been expended entirely, or?
So for abandoned mine, that is almost the case. There is actual a residual that rounds out on this. So a matter of less than a decimal place. Zortman and the 2 Zortman accounts are open for trust fund investment, but have been unable to do accurate cash flow projections that would make a trust fund investment pool allocation appropriate.
So they just haven't been funded by the legislature and since?
Well, to say it differently, they're all in STIP. All the money's in STIP.
Okay.
And
Great.
And so before a client can invest in the trust fund investment pool, all their money is in STIP. STIP's the default. And then we'll come before the board and ask if you will approve an investment policy that allows an allocation in something other than STIP, usually trust fund investment pool. Let's see here. So you heard me talk a little bit about appropriate. What's an appropriate investment in terms of the trust fund investment pool? And to answer that question, I should talk about the difference between the trust fund investment pool and the short-term investment pool, or STIP. So the major difference is that STIP is much like a money market fund where the transactions are at the buck, and so very de minimis risk of any gain or loss happening there. In the trust fund investment pool, transactions are at market value, at the underlying market value of the assets. And so there is a possibility of a loss on a sale. And so before we think of a client as being appropriately allocated trust fund investment pool, we have to be well assured that the increase in yield that they might get from the trust fund investment pool would cover any foreseeable losses from the fluctuation in market value, should they have to sell those units.
Question, right now, what's the difference in earnings roughly between the short term and the trust fund?
Well, we're a little bit inverted. So this morning, the trust fund investment pool market yield was 5.33%. That's it.
5.4.
So 5.4, so 0.07% difference, essentially the same.
But it's just an unusual thing too, what's going on right now.
Right, right. We have an inversion in the yield curve that we'll talk about exhaustively.
I just want to note that Jim from RVK is here. We've got the chairman and we run a tight meeting. Thank you for being early.
Wow. Okay, that's a heck of a start.
So be ready.
Becky has already warned me.
I'll just refer to the objectives of the trust fund investment pool and of the clients of the pool. Strategically, it's to provide a diversified investment vehicle for participants that offers return to support their mission. It funds their programs. The investment objectives are to provide income by assuming a prudent amount of risk and to preserve their principal, diversifying through various asset classes. So we want to diversify investments, we want to increase the yield, and we want to enhance the total return. So if I could refer the board to slide 6 that shows the approximate $3 billion of assets in the trust fund investment pool and their allocations. You can see that it's diversified among core fixed income, real estate, non-core that Jason will talk about a little bit later. We're starting an allocation towards real assets, but the large majority of the assets are in the core fixed income portion of it that's internally managed. And so with that, I am going to turn it over to Kirsten to discuss core fixed income and fixed income in a little more general terms.
Morning, everyone. I'll be starting on page 7, your tab high. What is fixed income? It's a contractual obligation between the investor, in this case us, and a corporation or government entity to pay both principal, which is the initial size of the bond, and interest, usually in the form of a coupon payment, over a set period of time. This could be 1 day up to 30 years. Fixed income obligations are senior to equity. This means the investor would be made whole holding debt before an equity investor in the event of a default. And if you're talking about trading equity versus fixed income, there's a big difference. In a minute, we'll look at some Berkshire Hathaway. If you're an equity investor, you might say, I like this company, I want to buy it. Great, you buy the equity. There is, well, in this case, 2 share classes, but there's 1 equity. If you're looking at bonds, well, Berkshire Hathaway currently has 306 outstanding issues. So you have to know not only, relative value for the company, but also which bond you like, how long you want to hold it, what kind of interest you're earning on it. With that, instead of reading all the terminology that we now put in the appendix, I will ask Willie if he could share his screen, and we will look at a Berkshire Hathaway description page in Bloomberg. And this way I can point out some of those terminologies instead of reading to you. We are going to say we have $1 million of this Berkshire Hathaway bond. Up in the top left corner, you can see that the coupon on this is 3 1/8. That means every 6 months, we as an investor are receiving $15,625 every 6 months to maturity, which is the next part. 3/15/26 is the maturity on this bond. That means we'll get our $1 million principal back on that date. Finally, if you look on the right-hand side of the description page, it would show all of the bond ratings. This is a mid-AA rated bond. No, sorry, that's okay. This is our YAS screen, which is what us as fixed income always use for when we're looking at trading it. Okay, there it is. And so you can see it's a mid-AA rated bond at the agencies. Willie will be talking about this particular bond in a little more detail in a couple of minutes. So I will refer back to slide 8 in our presentation here. What are the objectives of fixed income? Well, total return, which makes sense. That's the sum of income. Coupon payments I was talking about, that's where most of the fixed income return comes from. But there can also be change in market value, appreciation, depreciation, which is usually driven by changes in the yield curve or spread changes. And then diversity and liquidity really go hand in hand. The fixed income risk profile is different from equity and the other asset classes. If you're talking about a stressed environment, the treasury market is one of the most liquid markets in the world, and you are still able to trade quickly and at a fair value when these markets are stressed. That's not always the case with the other asset classes, so it is a benefit to hold this type of securities. Okay, page 9, we'll talk about the fixed income risk factors. The biggest one is interest rates. So if you want to talk about the real risk-free rate, let's say Kirsten, as a Montana resident, gets her $1,250 income tax rebate. Do I spend it immediately, or do I put it in my FDIC insured savings account? Well, it kind of depends on what my savings account is paying me. If it's over and above inflation, I am more likely to save it than to immediately spend it. And that brings us to the inflation risk. My $1,250 today, if inflation is very high in a year, maybe that $1,200 couch I wanted to buy is now $1,400. So you think a good example of this is lottery winners. Do they want to take the lump sum, or do they want to take the annuity payments? Well, if they think inflation is going to go up and go up quickly, they probably want the lump sum, but I am not one of those lottery winners, so I won't opine on that anymore. Finally, maturity risk. I was talking about how Berkshire Hathaway has all of those different bond issues. Well, the longer the time frame holding these bonds, the more likely the corporation or US government can make bad decisions that make it less likely to get paid back that principal, which is your largest cash flow. So the longer you hold a bond, the more risk there is. And that brings us to also default risk, same type of idea. If a company has a history of making bad decisions, well, I'm going to need a bigger coupon to hold that bond. And finally, liquidity risk. I talked about the treasury market being one of the most liquid markets in the world. But if you think of corporations, sometimes they have smaller issues. These are harder to trade because everything we trade in general is over the counter. That means we are always negotiating prices. There is no set price like in the equity markets, trading electronically, except for in treasuries, like I said, very liquid, able to do electronically. And with that, we'll finally go to page 10. If you do not.
Just ask you, I know we have a set approved list of brokers or whatever. Do you use basically all of those approved ones, or do you have ones that perform better for us than others, or how does that work?
Yeah, we have a group, and we always do our bonds in competition, which is why we'll be showing you market access here shortly. And that is an electronic trading platform. So we are actually able to go out to market and get prices from different brokers all at the same time and know we're getting best execution. Some of those illiquid bonds, though, we may go out and not get any prices we like. And then maybe a broker will come back to us and say, I can work at the price you want, and tries to get it done that way. Does that answer your
Yes.
question? Okay. Great. We'll go back to page 10. If you only remember one thing I say today, remember this teeter-totter here. Putnam made it years ago, and it very well shows that inverse relationship between bond prices and interest rates. If interest rates go up, bond prices go down. Maybe explains our fixed income returns last year pretty well. And with that,
You might show, I mean, you bought this at 99.9 and now it's worth 95. That's exactly what happens when interest rates go up.
Yeah.
If you go back to the slide before, it shows exactly.
Yes.
And that's why you need a pool
Yes.
and stuff, and it's also why the longer term you come out, you may take a haircut because of changes in value.
Right, correct. You got it exactly right. Yeah, so page 11, I would like to hand off to Willie and Sam. They're gonna walk through a couple of our team processes.
So why don't we pause here,
Okay.
just to throw the newbies off even more.
Guess when they were getting nervous.
Yep.
Oh, this is good. This is
Right.
good for us.
And go back to tab 1 for those decisions and public notice provisions,
Okay.
and then come back.
Do you want to wait till 11:15 to do that?
I think we'd probably throw them off even more if we made them just sit there for 10 minutes. We have some intros to do, we can do as well.
Okay.
So, hold on, let me do that. So if you wanna do minute approval and, so D, E, F, G, H, and then C.
Okay. So welcome everybody to tab 1. We've changed a little of our schedule here, but we want to make sure in particular there's time for public comment. And so the first thing on the agenda here for the board, we've already taken roll. I do want to make sure everybody's noticed that we do record the meeting, so keep that in mind. And so the first thing is the approval of the minutes of May 24th, 25th, and of June 22nd. The minutes were in your packet. Is there any additions or corrections? Seeing none, I'd entertain a motion to approve the minutes of the 2 meetings. So moved. Is there a second?
I'll second.
Okay, moved and second by. Okay, so again, with no additions or corrections, call for a vote of those 2 minutes, 2 meeting minutes. All those in favor say aye.
Aye.
Any opposed, say the same sign. If not, the minutes are approved unanimously. The next thing we have to do is go over some administrative business. The first thing is a report from Mark on the audit committee.
Thank you, Mr. Chairman. The audit committee met this morning. We welcome Dwayne Iverson as our new member to the committee. And Executive Director Villa explained that and Julie Feldman explained that the legislative audit is going on right now. They are on site for the fiscal 23 year and expect to be here until October. They've also have provided detailed information, 1,900 documents to Whipley, who is doing the SOC report, SOC audit of our internal controls. They've also contracted to document all of our internal control processes and coordinate them into one uniform format, which will help going forward with understanding internal controls and also with any transition to staff. And they have also done a complete SOC audit review of all third parties as well. And there were no decisions to be made by the audit committee, and that was the result of our committee.
Thank you, Mark. Any questions for the audit committee or Mark? Hearing none, thank you for the report. Jeff, we'll go to loan committee. I think we do have to vote on a couple things, so.
That's correct. The loan committee met this morning. Executive Director Villa discussed kind of progress in relation to the on the housing front in relation to programs that are being deployed there. At this point, it seems like there's a lot of preliminary work and a lot of preliminary interest from the various counties across the state. We continue to meet with those counties to inform them of those programs and the opportunities there to expand housing or housing in general. In addition, we reviewed and approved 3 participation loan requests, 2 of which will require approval by the full board due to the overall relationship size. The first loan we reviewed and approved was for Eagle Enterprises. It was a $4.1 million participation. In addition, we reviewed and approved M2DT Holdings, 2 separate participation loans, which combined for $4.3 million. And finally, we reviewed the House of Yum, which was a participation loan for $1.1 million. So I'll turn it back to Chair Prothero for the full board approvals for the Eagle Enterprises and M2DT Holdings.
Okay. So as our process works, depending on the loan size, staff can approve some, loan committee can approve some, and then the bigger ones have to go to the full board. And that's what we're doing today on these 2 that are large enough that the full board needs approval. I want to note in the minutes that we're not going to spend a lot of time in detail on these 2 credits because the loan committee looked at them and approved them, recommended approval to the full board. And then the full board was actually at loan committee. So the full board has got the details of this. And so that's why, if you look at our minutes, that we didn't spend a lot of time on these because we did spend with the full board the time in loan committee. And so the first one we're going to look at is Eagle Enterprises, which is a car dealership. And so Jeff, do you have any comment, or do you want to just say the loan amount, or however you?
Yeah, sure. So Eagle Enterprises, they have outstanding participation loans with us in addition to this, what's being proposed for approval today. All those prior commitments have been paid as agreed. From kind of an overall credit standpoint, it appears to be a very strong and sound borrower with a great track record and a good project expansion. So seems like a good use of proceeds. Total request from the Board of Investments in regards to our participation is right around $4.1 million.
Okay. So with that information, I entertain the motion to approve the full loan request.
Move to approve,
Okay.
Mr. Chairman.
Because the prior one is, they have another participation loan pushes it.
Second, Anderson.
Second, moved and seconded. Any additional questions or comments? If not, and we're okay there?
Yep.
Not, all those in favor of Eagle Enterprises approval, say aye.
Aye.
Any opposed, same sign. Hearing none, Eagle Enterprise loan request is approved unanimously. The second one is, get the numbers here, M2D2 Holdings. And again, this requires full board approval. Jeff, do you want to just talk a second on that one too?
Sure, yeah, another participation request, similar to Eagle Enterprises. This one is coming through Bank of Montana. This project is for the Brett's RV kind of enterprise specific to their Billings location. Two separate loans are being participated, both to the same entity here. The combined dollar amounts right around 4.3 million, 20-year term. Again, similar to the prior request, this is a strong borrower with outstanding participation loans with the Board of Investments. All of those have been paid as agreed in the past. Very strong borrower, sound credit, and an expansion of an existing facility, which seems like an appropriate project for us to participate in.
Okay. So is there any questions or comments from anybody about this loan request? If not, I'd entertain a motion to approve the M2D2 Holdings, Inc. Loan request. When that motion is recorded, it's broken out in two participations to make sure that we completed the correct underwriting. And so the motion would approve both of those loans.
Okay, I'll move both of those loans,
Okay,
Mr. Chairman.
good. Is there a second?
Second?
Moved and seconded. Additional questions or comments? If not, all in favor of that loan request, please say aye. Aye. Any opposed to that loan request? Hearing none, that is approved unanimously. So anything else, Jeff, for loan committee?
That was it for loan committee. Thank you.
Okay, so thank you. Maggie, HR, you got a big, long report for us?
We didn't,
Okay.
that's why we're so far ahead. I'm gonna give HR credit for that.
There you go.
There you are. We wanted to get you some credit, so thank you. Now, the next part is comments from pension board members. Who wants to go first? Go ahead. Maggie, go ahead.
Go ahead, Meg.
Okay,
So you didn't get out of talking.
the
then, right?
the Impera board had an audit committee meeting on the 9th, and we had a full board meeting on the 10th of August. During that meeting, we had presentations from our vendors, 3 of our vendors, RVK, who's a consultant for the board. We had PIMCO and Empower Retirement. And we had general board orientation for our 2 new board members, who are Dave Galt and Doug Carey. So we also had approval of local government contracts for the town of Jordan, Lake County Conservation District. And we had 2 deferred comp, 457 plan adoptions by Hot Springs School District and Fort Tyne School District. And I think I'll talk about the audit committee report a little bit. We had 23 employers audited, 7 had no findings, 16 had findings. My favorite finding of all, which happens every meeting, is the optional retirement election forms were missed. So that means if individuals are less than half-time, you're not required to participate in PERS, but you're supposed to give them the option to opt in. And if you don't, and they later become members, they can ask you to go back and pay the employer and employer portion to bring them current. So it's ridiculous that we miss it all the time, but we do.
So do they have to affirmatively opt out when they're
Yes.
half-time or less?
Yes, they have to sign a form saying they don't want to participate, or the employer could be on the hook for the cost later if they become eligible.
So if they opt out and then become full-time later, they can only start as the time they become full-time?
Right, they can buy service, but then there's a cost to them.
Sure. Okay. Thank you.
Another one that happened this time, which had never happened before, were pay codes were used that were pensionable that weren't reported. One of them was for a coroner, one was for a call out. There were payouts of annual and sick leave reported as pensionable, but when people are allowed by entities to take payouts when they didn't really use them, such as a payout, I have 100 hours on, I want to take 50 as just a payout, it can't be reported, it's not pensionable, so they caught that. There were a lot of employers this time that reported many of their employees with just 1 hour, which impacts their service credit, so they had to go back and fix those. I'm just giving you There were some that were missing hours completely. There was one that was reported twice that they caught. So these audits play an important role for the Amparo board. So I'd just like to keep you all current on those. I'm trying to see what else we had on the agenda. Oh, the 457 plan, we did provide for an annual fee. I guess I'd call it a break for a period of time because there's a reporting, you're supposed to have between 6 and 12 months of reserve, and we were exceeding that. So with this break, we're hoping to bring that down to where it's within the range that it's supposed to be within. We also approved actuarial services to audit our actuary, which is a crazy thing to think about, with Millman and Roberts. And we approved with Empower an option for our employees to have receive financial advice. That's my report. It was longer than usual, sorry.
Well, thank you. Any questions for me? If not, Daniel.
Yeah, thank you. The TRS board met a couple of weeks ago, August 10th. Every other year we do a strategic planning meeting for a full day, and it was time for that meeting. And I think the board is doing a lot of things really well. So we focused on things that weren't really core, but maybe to expand communication a little bit. And one area that we talked about was maybe communicating a little bit more with new teachers on the three-legged stool of retirement, being their TRS pension, Social Security, and some other investment like a 403B. And actually the idea came up, and I might talk with you offline, Maggie, because I know you've got some background with the administration of the plan, but the idea came up that maybe teachers all over the state might be eligible for the deferred comp plan through the state. And we might want to help if that's possible. So we want to have some conversations about that. Director Graham was very happy about the fiscal year since inception return being above the actuarial rate. I'm going to let you know that. Keep that up. And we are short a couple of members still. So we've got a pretty tight board over there right now. We're still haven't had a couple appointed that we need. So looking for 2 more. That was it.
Chair, could I just make a comment about the 457 and teachers?
Certainly.
The states are divided on that. Most states, I believe, and we haven't done a survey of this, allow teachers just like general employees to belong to the 457 plan. It's a statewide plan. There are a few states, California is one of them as an example, where there is a separate DC plan for the teachers. So I will make an offer to the board if they ever want a presentation on the sort of pros and cons and general layout of what's happening outside of Montana with respect to that situation. I realize that eligibility for teachers in Montana to be in the 457 plan that's a legal issue that's way above our pay grade. But we can at least give you some clues as to what's happening elsewhere in the country. So I'll stop there.
I think that'd be great. I mean, right now it's a hodgepodge of different 403B providers, and there's no communication to new teachers or teachers that have been there a long time about what's available in their district, and every district's different. It makes it really hard. And if it was something like, hey, we can take this out of your paycheck on day 1, here's a form, I think there'd be a lot more uptake.
I think you will find our comments quite critical of these scattered 403B plans. They're an administrative nightmare, and they're extremely confusing to teachers, and they're sometimes inequitable across school districts. And
most of them are under, well, maybe not as much anymore, but they all used to be tax sheltered annuities, which are really expensive. So just not ideal.
The university system went from having multiple 403Bs to one 403B.
So anyway, the offer
Because
stands.
it was a nightmare to.
Okay. Any other questions for Daniel? If not, occasionally we'll have legislative updates. We don't have anything this meeting.
Senator Trebus is on.
Oh, is he?
Yep.
Oh, I didn't see you there, Senator.
Hi.
Welcome. Senator, do you have any report for the board here?
Yeah, I think what makes sense for me to maybe mention here is just kind of what's going on in other parts of the legislature right now and what our interest was during this last session. I've been on the Revenue Interim Committee and the Local Government Interim Committee, and last session, we studied the coal trust and coal markets. This last session, obviously, we were very active in housing issues and interested in increasing the supply. So that's kind of what I'm looking at and looking for when it comes to, what loans are being made into residential housing markets. And then I think that's just kind of why I think it makes sense for me to be here specifically, but also I think what the legislature's interested in currently.
Well, thank you. Any questions at all for Senator? Hearing none, thank you. So the next thing we want to do is introduce a couple of things. The first thing I'd like to say is, he's kind of been introduced already, but Dwayne Iverson is the newest member of the board. I want to make sure you feel welcome. You've already seen our process, sort of. We're a little more informal than the legislature. If you have a question, you don't have to go through the chair. You can just ask it. I do reserve the right, if it's heated, to make them go through the chair. So we want to encourage your participation and appreciate you given the valuable time that you're going to give to this organization. Is there anything you'd like?
Great orientation yesterday too, so.
Okay, so anything else you'd like to say, or just in a way of introduction?
I guess to give you a little background, I've been a CPA that's practiced in Shelby since 1977 and stuff, my own practice. I sold that a couple of years ago and stuff, and Shelby's a good place to raise kids. We got 6 kids, they're all boys except for the 5 girls, so. Got 21 grandkids and stuff, so that keeps me busy.
Okay, well, welcome. Dan, we have another introduction. Do you want to do that?
We do. We have Jessie Salois. I never know if she joined us. She was in state government, left state government. We got her to come back to state government. So maybe you want to just give us a quick introduction of yourself?
I'm Jessalyn Salois. I started at Whipley as an auditor for 4 years and then to DEQ and then briefly went to a nonprofit and came back here. So about 10, 12 years of experience, depending on if you include intern stuff. So
Which we do.
12 years of accounting experience behind me and excited to be here.
And accounting was nice enough to throw her right into STIP where all the wolves live.
Well, welcome. We appreciate you coming here with that background, and I want you to know that the board is always open to any suggestions you may have. Okay, anything else, Dan?
Now public comment.
Okay, so one of the requirements of the open meeting law is Board of Investments has to call for public comment. So at this point, I'd like to call for public comment on issues within the board's jurisdiction. And I think we may have 1 or 2 people that want to make a public comment. So Dan, do you want to just turn it over?
Anybody that'd like to comment, feel free to raise your hand. Any public comment? Any public comment? All right, we have no public comment.
Okay, well, if there's anybody there that did want to do a public comment, if they didn't do it now, there's certainly welcome to do it at a future meeting. We did call for public comment 3 times, and so we can move on from that. So other than that, I think we've got tab 1 completed, Dan.
Tab 1's done.
All right, so let's go back to tab 5. I think we're on page 11. John, are you awake over there?
It's just to punish the board for interrupting us. We're gonna start over. Just to synopsize, we talked about some of our clients, how they got there. Kirsten talked about fixed income in general. Willie is going to talk a little bit about idea generation and execution, and Sam is gonna talk a little bit about portfolio to trade execution. As if it weren't stressful enough for them to be in front of their first board meeting, we thought it would be cool if we did these actual trade live, real dollars. So, Willie?
Don't screw up.
I'm Willie Gross, investment analyst with the fixed income team, along with Sam Holman. We'll be going through two of the processes that the team as a whole does on a regular basis. And I'll be talking about corporate bond trading. So when we're talking about corporate bonds, we split the companies or prospective companies into several industries. And so each team member is assigned a couple of industries. On the screen are some examples of these industry assignments. So John has energy, Kirsten has communications, Sam has basic industry, and I have consumer cyclical. What does it mean to have an industry? A lot of it has to do with company research, and that's where the credit matrix comes in. And this is a look at the credit matrix. Specifically, this is the, whoops, sorry. There's the credit matrix. So this is the P&C side of the insurance credit matrix. And so this is an internally developed tool that helps quantify the risk present in a given company as it pertains to its debt securities. And so throughout the credit matrix, there are about 25 different criteria that we use to help quantify the risk in a company. Some of them are qualitative, like the potential for M&A. So we'll look at M&A history and whether or not there's a chance of some material credit risk sprouting from any mergers or acquisitions coming in the future. Other criteria are more quantitative. For example, we look at net debt over operating income and free cash flows to total debt, and then assign those a score based on predetermined intervals. And so once we've collected all the data, gathered all the information, we aggregate these scores into a final ranking. And so you can see here, these are the P&C names that we possibly would want to look at in terms of buying bonds. And so the scores correspond to the rankings put out by credit rating agencies. So for example, the score of a 4 from us would correlate to a score of an A- from the national credit rating agencies.
So the higher the score, the better, the lower? Correct.
So the scales from 0 to 10, 0 would be the lowest score that an investment grade name could have, and then 10 would be AAA. And a negative score is possible, but once a company gets into a negative score, we take them off the approved list. So then we can add them on if stuff changes, but up to team review. So we can look at a real and current example of how this works. So going back to the Berkshire that Kirsten was talking about before, you can see here, zoom in a little bit, that we have Berkshire rated as a 7, so a very solid score. In our minds, that corresponds to a AA- or a AA3. However, in reality, the credit rating agencies have it at a AA2 and a AA. So they're actually one notch ahead of where we are. And in our minds, that's kind of signaling that Berkshire is potentially overvalued by the market and something that we might want to switch out for a higher value name. On the other hand, you have a company like Marsh McLennan. We have them rated as a 4, so a lower score than Berkshire 7, but relative to where the credit rating agencies have it, we believe that there's some value in Marsh McLennan. So our 4 corresponds to a score of an A3 or an A-, and the credit rating agencies have it at a Baa1 or an A-. So they, we think there's a potential that this name is undervalued in the market. And so we would at this point think, okay, maybe we can sell some of the Berkshire that we own and replace it with a purchase of Marsh McLennan and add some value to the portfolio.
Can I ask a question? Yeah. When we had problems in the past, the rating agencies, I thought, did a complete failure. So how much credibility do you have with the rating, or do you think the rating agencies have?
John or Kirsten can step in, but I guess I can just quickly say that we have a lot of sources that we go to, and the credit rating agencies are one of them. But definitely we don't trust them fully, and use a lot of different sources to try to understand how strong a company might be.
Yeah, so Jack, that's the impetus behind the developing this, is so that we aren't relying on the credit rating agencies, the NRSROs. We're relying on our own internally generated metrics. And we're not so foolish as to not ever look at what the credit rating agencies say. Sometimes they have some good comments, but quite often they're either stale or move too fast or move too slow.
Okay, thank you.
So like I was saying, that at this point, we think Berkshire may be overvalued and Marsh McLennan may be undervalued, so there's a swap potential. We would go out to the various tools that we have, one of which is the Bloomberg terminal. Within the Bloomberg terminal, there's a lot of different analytical screens that we can look at. One of the most useful is the fixed income worksheet screen. And so what we're looking at here is a graph showing all of the bonds that we own in the MU8M account. And so on the x-axis, we have maturity. On the y-axis, we have G-spread. You can see it's a little bit small on your screen, but this red dot down here is the Berkshire. And so you can see that it's yielding fairly low relative to the other bonds that we hold. It makes sense because Berkshire is one of the most respected names out there. But we also do think Marsh McLennan is a respected name as well, and there is the potential to gain some G-spread there and maybe add some value. So once we've gone through this analysis and other types of analysis within Bloomberg, we would bring this swap idea back to the team where it would be discussed. Going back to what Kirsten said earlier, where each company has, potentially hundreds of bonds out there, maybe there's a better Marsh McLennan bond that's 1 year earlier, 1 year later, whatever it might be. We go through all the potential swaps that we can, try to figure out the best option, and from there we can go ahead and execute the trade if that's what we decide to do. There are two ways to execute a trade. The first is calling up a broker, and we can see if they have any interest in buying or selling the potential trade at the levels that we're looking for. The second option is going out to Market Access, which is what we are looking at right now. Market Access is a software that is used by entities like the Board of Investments to buy and sell directly with other buyers and sellers. So these are all live trades going on right now. So someone's trying to trade Capital One, someone's trying to trade Pfizer. And what we're going to do right now is put that Berkshire sell out. And so we're going to end up with our own Berkshire out on the live market here. We've already loaded this Berkshire sell, so we're going to try to sell $1 million of it. I'll set a 10-minute timer because that gives the potential buyers and sellers a chance to respond. While that 10-minute timer is counting down, I'll hand it over to Sam and she'll talk through the portfolio to trade execution. So, Sam?
So is that out there right now?
The Berkshire?
Yeah.
We're about to put it out right now.
Oh, okay.
So we'll do 10 minutes and then when Sam's done, we'll come back to it and see how it turned out.
Does that make you nervous, Dan?
I'm nervous about who bought that Argentina bond at the top of the screen a minute ago. I hope we didn't click something wrong.
All right, good morning. As Willie mentioned, I will be walking you through a portfolio to trade execution. This is a trust fund presentation, but for the purposes of this demonstration, I am going to be doing a trade in the STIP Reserve. The STIP Reserve is a $70 million portfolio that I get to manage, and the way we have it set up is every week we have a 6-month T-bill roll off. So every week I'll buy a new one to replace that one. So the first thing we're going to look at is this port screen in Bloomberg, which stands for portfolio. And we could do a trade in any of our funds. I already have MU8E, which is our STIP Reserve, pulled up. And in here we can see all of our holdings. I do have it sorted by maturity. So this first one matures on the 24th, so tomorrow. So today we'll execute the trade for settlement tomorrow. So we can see we have $2 million rolling off. So I'm gonna buy another $2 million to replace this. So now that we know the amount, we're gonna go ahead and go to this FIT screen, which stands for Fixed Income Trading. And this first screen is just kind of an overview of all the markets. But we know we're gonna be buying a 6-month T-bill. So I'm gonna go ahead and go into this Bills tab. And we're gonna be buying a 6-month bill. So I'm just gonna find the date that's closest to 6 months. It's always this one that's yellow over here in the 6-month section. And I'm also just gonna peek out the yield, which is 5.84 or 5.48. I'll just keep that in mind as we send it off to the brokers. So from here, I'm gonna go ahead and click on the security and type in a B, and that'll pull up our buy ticket.
What do you type in there? Did you?
The letter B for
Okay.
buy.
All right.
Yeah. So in here, I'll go ahead and enter the amount. And the way bonds work, you buy them in $1,000. Each bond is $1,000. So like you put, and M's stand for 1,000. So when I type in 2M, it's $2,000 bonds. Because that's a little confusing. I always check this area down here to make sure it is bought at a discount, but I just make sure that it's close to 2 million. Also just go through and make sure everything looks right, it's right security, settles tomorrow. I'll make sure we have it allocated to the right fund, which is MU8E. Go ahead and go back to our details tab. And then next step is to check pre-trade compliance. And this is a process in Bloomberg, but it's set up by our ops and risk management team. And it basically just checks that we're not doing anything outside of policy guidelines or other restrictions we have set up. So for example, let's say I accidentally put in 2 M's, which would be 2 billion. And then I checked this go for compliance. I'll just note that we aren't allowed to trade more than $50 million at a time. So when I hit go for compliance, we'll get this warning, no trade to exceed $50 million. And I wouldn't be able to push this through without additional approval. So I'll go ahead and correct that. And now when I check it, it's just gonna be a quick flash on the screen. We may not even see anything, but that'll just mean there's no issues. All right, and then I'm gonna go ahead and hit send, and this will send it to the desk, which is our TSOX screen, which stands for Fixed Income Execution Management. And one thing about the desk, once we send it to the desk, anybody on the team can finish the trade. This is helpful for a couple reasons. One, occasionally we'll want to do a buy and sell at the same time. This allows us to do that, or one person can put both the buy and the sell out, but we can have 2 different people execute. And the other one is, say John wants to buy a 20-year treasury, he puts it out there, gets pulled into a meeting, he can just yell down the hallway and tell one of us to finish it. So.
And does.
Yes. So in this screen, I'm gonna look down in this bottom section here and just kind of get an idea where it's trading. So I think I'm gonna want to see 5.5. We'll see if we get there. Just gonna keep that in mind. So then we're gonna go ahead and hit send. And in this screen, again, I'll just double check that I entered everything correctly, right amount, right security, correct settle date. And then the next step is to select our brokers. So the brokers in this list that have check boxes next to them are the ones we're approved to transact with. And then Bloomberg automatically sorts this list from best to worst. So when I go ahead and hit this broker box, the top 5 brokers are automatically selected. We're only allowed to work with 5 at a time, so that's where that limit.
Best to worst on what criteria?
Best bids, so the best fields. And then, so it'll pick the top 5. I will pick 3.
So of the, you have 5 up there, but you have the ones that you're approved ones.
Mhm.
So those are the ones you could buy from, those 3 that are clicked then?
Yeah, and you can also look over here on the right side, those, so Jeffries, Barclays, Bank of New York, Wells Fargo, and StoneX are the ones that Bloomberg picked for us. I will occasionally scroll through, and if there's a broker that we know isn't going to participate, we may uncheck that box and check the next best one. But I'm good with all of these brokers. And the next step is to submit. But before I do that, because this happens pretty quickly, I'll just note a couple things. One, Bloomberg will put the best option at the top, the best yield at the top, unless there's a tie, in which case the 2 best or the tied names will both be green. And then I'll be able to pick which one I want. I have that level in mind. I would like to see 5.5. And then third thing, I will wait a few seconds once I hit submit to let all the brokers that want to participate get their names in there or get their bids in. All right. I'm 7 months into this, so this part still makes me a little nervous, but.
It makes me nervous.
I don't know enough to be nervous. Okay.
So I'm looking over in this column. Doesn't look like we're gonna get there, but. So I'm gonna hit this top one.
Why the top one?
So Bloomberg automatically puts the best one at the top.
Okay, so you always pick the top one, or you said you might not, right?
For the most part, yes. Occasionally there's a tie, in which case there would be nothing in this top line. But
And that's one of the approved ones, right?
yes,
I can't read it very well.
yeah.
But you didn't get the 5.5.
Not close. All right, so it was accepted. That's kind of the last step. I'll double check again in TSOX. It shows completed. We did it with Wells Fargo and that filled in. And then last thing I'll do is just send a message over to Tim and Ops and just let him know that we did this trade, and he'll let our accounting team and our client trade support over at State Street know that it's ready to be booked.
What if you forget to do that?
Um,
Does he have another way of knowing that you did it?
So that process is automatic. It's a courtesy that we let Tim know. If Tim were gone or we forgot to do it, it would show up as being available to send tomorrow.
It doesn't settle till tomorrow, so that gives us a little buffer. Any other questions?
Do we buy new issues?
Yes.
Is that a totally different process? Yes.
You do the issues.
So Sam, you got flowers today?
Yes.
Your birthday or?
No, I just was nervous and my parents were like, here you go.
That's so nice.
Yes.
You know, I used to work with your dad.
Okay.
We were talking about you when I ran into him.
Nice.
Not to make you more nervous.
No. Okay, I'll go ahead and hand it back to Willie.
Well,
Kristen, did you
Kristen's
want-
gonna talk new issue.
Oh, okay.
We didn't hit it.
It's interesting to me.
Oh,
He has a minute and a half.
Interesting, seriously.
Yeah, so for new issue, it's a totally different process. We have a new issue monitor in Bloomberg that we'll have up, and if any of our approved names come out with a new issue, whoever is the coverage on it will pull up that FIW screen for the entire industry, and we will graph out where the IPT is, initial pricing, where they say they're going to be. It almost always tightens from there, and see if there's relative value in that new issue. And then the games begin for it. We have to put in how much we want with the brokers that are on the new issue with them. You never get the allocation you think you're going to get. we make sure that if we got the entire allocation we asked for, we would not be out of policy. If we got, if we went in for 50 million and we got 50 million, that wouldn't put us out of policy in any of the portfolios. So that's that maxes us out. Even if we hear, the book is 5-6 times oversubscribed, which has happened before. So we know when we put in 50 million, we might get 10 million, then that's what we get. And of course, we always have a level in mind, if it tightens inside where we think that relative value is, we'll drop out of the book and then not get anything.
Similar for treasury, new issue treasuries.
Yeah, we don't do the new issue or the win issue treasuries as much. I will say we can, but not quite as often. And then of course the treasury floaters, we actually have to go out to the auction, and it's a Dutch auction, so that's also a totally different way to do it. You can say, I would buy, if it's a STIP buy, I'd say I would buy 10 million at this level, 10 million at a wider level, 10 million at a wider level, and then Dutch auction, you get kind of the best level. So maybe I get filled on nothing, maybe I get filled on the whole 50 million at a better price. So that's kind of an interesting one as well.
So it's worth going secondary just so you know what you're gonna get. You can.
Yeah, a lot of times definitely.
Makes sense.
So this shows you why Bloomberg can charge us so much money.
Yeah, yes, it does. It would be
Doesn't
very
excuse
difficult
it.
to do our job without Bloomberg.
And why Mike Bloomberg is a billionaire.
Yes.
Never getting elected.
I'll let Willie come back up to finish
That's right.
up with the processes.
So just quickly going back to finish up the Berkshire cell. These are the offers that came in, I'm gonna say who bids. And so we're looking at this column here where it says spread. That's the spread above our curve. And so ideally we're looking for something a little bit lower, a little bit cheaper way, or a little bit more expensive way to sell this. We did not get the level we were looking for, and so we passed on this, and we'll live to try to sell it another day when we can get the levels that we're hoping for. And especially with a name like Berkshire, that is a strong name, we're not in a huge rush to get rid of it, so we'll just wait until we see what we want to see. We can go back to John and Kirsten for the rest of the presentation.
Thank you, Willie. If I could refer the board to slide 12. We're looking at the historical yields of the trust fund investment pool versus the Bloomberg aggregate yield to worst, or the copper line there, if you will, is the universe of bonds that we could invest in and what they have yielded over a period of time. The blue line is the distributable book yield of the pool. So you will probably not find distributable book yield in any investment literature. It is simply what the fund has distributed divided by its average book value. And that's the key metric that the participants of the trust fund investment pool care about. They care about how much money are they making and how much is it gonna be over the next biennium. So something to observe from that chart on the left-hand side is you can see that over the years, the blue line, the distributable book yield is coming down, and it was in the mid teens, approaching the yield of the universe, if you will. And so that process is simply because we had bought bonds at higher yields in longer past history, and as those bonds matured, we were able to invest them only in lower yielding bonds. So the distributable book yield of the trust fund investment pool was coming down significantly. And so we thought about what we could do about that. If I can refer you to slide 13, I'd just like to show the allocation change that we saw over the past 5 years or so. So you can see back in 2018 that the 90% of the fund was in the internal core fixed income portfolio. Flash forward, or to the left, I guess, to 2023, and you can see a dramatic increase in real estate, an initial allocation to real assets, and an increase to the core, to the non-core fixed income portion. Over that time period, we've also saw about 700 million in inflows into the trust fund investment pool. So some of you on the board might recall in 2020, we came to the board and we asked for an increase in the maximum amount allowable to real estate. We asked to change that from an 8% max to a 30% max. And we did that in contemplation of that declining book yield. And frankly, worrying about rates going close to zero. At that time, you'll recall we said, well, we think that process of getting, well, we intended to go higher than the midpoint. We intended to go higher in the range. We thought that process would take a matter of years to play out. Fast forward to around, the late COVID timeframe, and we saw some excellent opportunities to go into real estate. And so Ethan and team, bless him, I guess Ethan would not be known as a patient man, but he showed a lot of patience with me. And as I said, no, we don't want to invest in anything. Yes, we want to invest it all. No, we don't want to invest in anything. But anyway, to his credit, he got quite a bit of it done. And we did that in core real estate funds, large open-ended funds. So we were able to get, well north of 20% into those funds, and that turned out to be quite good timing. I didn't, and I don't think anybody else believed that we were going to see returns of 20% in real estate for the next couple of years, and that's not what we were going for. What we were going for was the increased yield that we would get and pass that yield through to the clients. So that worked out good, but we've always believed that, we currently at least believe that Core Plus is going to be a value add to that portfolio. And so there's no great definition of what Core Plus is, but maybe it's a fund that has some geographic concentration, or maybe it's concentrated in an industry, or maybe this fund does a little bit of development. They do a little bit of build out before they start leasing. But the hallmark is the large majority of the overall return is just the pass through of rents from those managers to us and to our participants. And while we prefer the Core Plus space because of what we think will be significantly increased yields over core, we have to be careful about the timing and how we do that for a couple of reasons. One of the reasons being that those funds can and often do have a J-curve effect where you put your money in initially, and for a period of time you get little or no distributions, but later in the life you expect to get larger distributions. And so we simply couldn't do that to the participants. We couldn't put 25% of the fund into a set of securities that didn't currently yield significant money. Secondarily, timing and the pacing of those cash flows wherein we would exit core funds and enter core plus funds is very uncertain. So currently we've got millions, hundreds of millions in the exit queues for those core funds. Meanwhile, we've got commitments to the new core plus funds, but when they pull those actual dollars down is uncertain. So we work quite closely with Ethan and team, just kind of working through that and hoping to gradually make that transition. Point being is that we're lucky that we've seen increase in current yield of bonds that will offset some of that J-curve effect for a period of time. And then over a long period of time, we expect to get those higher yields in the future for the trust fund investment participants. So in conclusion, I think it's in the best interest of the participants to maintain that current yield while trying to increase future distributions. We'll make prudent adjustments to the asset allocation. For instance, right now we have a maximum allocation to core plus funds in the trust fund investment pool, up 25% of the real estate. Well, our preference is higher than that. We're not in danger of breaching it right now, but it's likely that we could come to the board in the future and ask for an adjustment to that maximum range for core plus. And then I will just point out again, cooperation among the fixed income team with the real estate and real assets team is important, and we look forward to that going forward. Finally, I would just say, I don't know if you got from the demonstration, but it is one of the funnest jobs that you can have in the state. And while we love doing it, we recognize how important it is, and just want to thank you for letting us do it and assure you that we take it seriously. Happy to take any additional questions.
Questions for John? I thought that was a good presentation. Do you?
Jack, could I ask a question? The 2/3 in the trust fund that you have in, still in fixed income, has the shape of the yield curve coupled with your interest on the real estate allocation, has it caused you to change your duration targets in any way for that 2/3?
Yeah, definitely, Jim. And at the beginning of this fiscal year, we were short duration in that portion, and at the end, we were a little bit long, and since then have gotten a little bit longer than that, and we'll keep an eye on going possibly even longer, and then the thought process simply being locking in higher rates for a longer period of time for the participants.
So you're trying to avoid the trap of reinvestment risk by doing nothing and staying shorter in the duration.
Right, and as you know, my preference is to do nothing, but in this case, you are actively playing.
Sorry, Dan's preference is not to pay you, so.
Nobody gets what they want all the time.
Thank you.
You guys did a great job. Thank you.
Excellent.
So Dan, what do you think on our break?
So here's what I'm thinking. Why don't we reconvene around 12? Hold on, you guys. Why don't we reconvene at 12:45? Do non-core fixed income until 2. You go at 2 for RVK. 2:45, John starts. And hopefully that puts us out of here at 4:15, 4:30-ish. If everyone is okay with it, I'd like to reward the fixed income team by letting them go first for lunch, because we are a food-based culture.
Wow,
that'd be
that's
great.
a lot of.
Yeah.
Will there be
He said
anything
there'd
left
be
for the
no
rest of
bonus?
us?
Yeah.
Sam already got flowers.
Yeah.
Not for us, though.
So 2:45 back here, non-core fixed income until 12:45. 2 to 2:45 RVK, 2:45, John goes, and then we go home.
Okay.
Does that work?
Works good.
Okay.
I'm skipping dinner, just so you know.
Oh, that's fair. All right, we're on break.
Okay, you guys, show us how to do it.
Jack and Mark.
Yep.
Did you not want to be zoomed in? All right.
Yep.
You're gonna force me to do this.
Yeah, maybe it's just not, it's never really.
All right,
been like
Savvy,
that.
are you ready?
Okay, we don't have to.
Entrepreneurship.
Doing public comment.
So we'll just call the meeting, the Board of Investments back to order. I think we're all the way on tab 6. Jason's gonna run us through that, so it's all yours, Jason.
Mr. Chairman, members of the board, good afternoon. You've had a nice warm-up, thanks to core fixed income team, give you some of the basics of fixed income, which will come in handy as my presentation. But go a little bit deeper into the world of non-core fixed income. I'll try to give you, and probably an area that you're maybe a little less familiar with, but I'll try to give you an understanding of the basics of the asset class, strategies within it, explain why these strategies or sub-asset classes are considered non-core, describe the objectives of the asset class, and to explain why we've chosen the strategies that we have to go into this asset class. Starting on page 2. First to note that this is the non-core fixed income asset class is all externally managed as opposed to the core fixed income team. So we have hired managers to execute these strategies on our behalf. This page shows some of the constraints and the policies for the asset class. There's the approved range of 5 to 9%, and as of yesterday, we were spot on at 7%, right at the midpoint. The investment policy statement allows for these 4 different strategies or sub-asset classes: U.S. high yield, preferred securities, emerging market debt, and convertible bonds. You have constraints on how much high yield is in the portfolio. It has to be at least 25%, no more than 75%, and 2, no other strategy outside of high yield can be more than 50%. Asset class benchmark is the U.S. high yield benchmark. That is the same benchmark we use for our individual high yield managers. And we have a long history in the asset class going back to our first investment in U.S. high yield bonds back in 2009. We expanded to in 2020 to create the non-core fixed income asset class, adding preferreds, emerging market debt or EMD, and convertible bonds to the investment policy statement. We funded preferreds and emerging market debt in 2020 and funded our convertible bond manager earlier this year. Slide 3 shows the ownership breakdown. So for most of the assets, obviously within the pension pools, so the pension has allocation to non-core fixed income, which includes those four sub-asset classes. State fund and trust fund have allocations only to high yield bonds. Slide 4. The biggest reason we have non-core fixed income is return enhancement. We're looking for to earn higher returns than we do in core fixed income. We're also looking for income, current income, that is the cash flow stream that we receive from coupon interest payments and dividend payments. So these are income-oriented strategies. That means the bulk of the returns we expect from the strategies in this asset class will come from the interest and the dividend payments from these investments. In certain markets, there can be opportunities for some additional capital appreciation to add to returns. Now is one of those times, and I'll discuss that a little bit more later. Another objective in the asset class is diversification. So we have a wide variety of issuer types in non-core fixed income, diversified by sector and diversified by region. And 2, in terms of performance, so we've We've chosen the strategies in non-core fixed income largely because they meet the criteria above, not necessarily because we expect them to outperform high yield bonds. Within high yield, we've chosen managers that have a conservative approach, which can lead to differences in returns versus the benchmark. The benchmark has no fees, no transaction costs, which can be significant in high yield. And that creates an inherent disadvantage to our managers versus in trying to outperform the benchmark. So outperforming the index isn't the sole or the ultimate measure of success in this asset class. I would add too that passive investing, that is a strategy that is looking to mimic the returns, or track an index, not terribly viable option. And there are a few reasons for that. But there are some popular ETFs. That's like an index tracking strategy that trades like a stock on exchange. There are some popular high yield ETFs in the market. They do not track the benchmark well. They tend to lag by quite a bit. And they are also not a low cost option. So in domestic equities, for example, passive investing is very cheap. With these ETFs, high yield ETFs, they are not that cheap. They are no cheaper than an active manager would be. So that is one of the things that's unique about the asset class, that an alternative of passive investing is not really a viable alternative. Slide 5. So the goal for the asset class is higher returns. So what are some of the risks associated with these investments? The biggest risk is credit risk. So that would be a risk of default or impairment, or not getting paid what you are owed at the time that you're supposed to get paid, or impairment, losing money on an investment. That is the chief risk. With respect to interest rate risk, so most fixed income has some level of interest rate risk. While the perception of high yield bonds may be perceived as riskier, this is one area where their high yield bonds actually have less interest rate risk than investment grade bonds do. And I'll explain a little bit more of that later. But many types of preferred securities and convertible bonds also have less interest rate risk than investment grade. Liquidity risk, I think the fixed income team discussed liquidity a little bit. Most of the securities in these strategies are traded over the counter. You may not be able to transact in times of stress, or if you do, you may unduly affect the price of an investment. And last risk here would be political risk. This would really apply more to emerging market debt, economic volatility in some of these areas, government instability, and currency risk in some of the areas of emerging market debt. Currency risk is at play there. Currencies fluctuate. And two, certain countries may have issues with central bank credibility, which can also affect the value of a currency. Slide 6. We'll describe the strategies within non-core fixed income, starting with the largest allocation, which is high yield bonds. So this is corporate debt. This is bonds issued by companies. The question is, so why do they carry lower credit ratings? And there are a few different reasons. One of the big reasons is higher leverage. They just have more debt on their balance sheet. Two, the high yield universe tend to be smaller companies. These companies may have less diverse revenue sources, maybe less stable revenue sources than an investment grade company would. And to a lesser extent, the high yield universe includes companies that are experiencing stress or distress. The table down below shows you the various credit ratings and what makes up investment grade, and that line between investment grade and high yield or below investment grade. I mentioned one of the areas of high yield that is different from core fixed income being interest rate risk. So high yield bonds tend to have shorter maturities. Given the higher credit risk, Lenders are less likely to extend you credit for longer periods of time. So, 5 to 7 years is pretty typical for maturity on a high yield bond. That means lower duration, lower interest rate risk. And we saw this play out last year. Even though the market was, fixed income was down, high yield outperformed investment grade by a wide margin. And so that was a good example of what drives returns in cases where rising interest rates, high yield bonds actually outperformed in a down market, which might be counterintuitive a little bit to some. Our approach, I mentioned our approach to high yield having a conservative bias. So in high yield bonds, the best you can do is to get back your principal and your interest. So the best way to win is by not losing. And over risk in a portfolio can lead to bigger downside risks. And so our managers deal with this by first having a strong credit research process to lower the risk of their exposure to defaults. And second, by having very diversified portfolios that can minimize the impact from problems from any single issuer. Any questions about high yield bonds before we move on to?
So what's your experience been with the defaults in this class?
Rare. It's not that we've not had any, but it's been very rare. I don't know if we've had one in quite a while, but
You guys didn't get caught up in Silicon Valley or?
in the preferred area we did.
Oh, okay.
Yeah.
Okay, so we're talking
there was some exposure to that, but like I said, with a very diversified portfolio, most of these impacts are limited. Given that have a wide variety of sectors, number of issuers, to minimize that impact from anyone.
Well, Silicon Valley was investment grade until they defaulted.
Yeah.
So Mark, I would maybe add, think about the environment we've gone through over the last, decade plus, really since the GFC. We have not had a difficult default cycle, partly because we've had such low interest rates. I mean, and so that has been a tailwind. And in fact, we've talked about it numerous times when we're looking at performance or something with RBK, how we've often, we've lagged pretty much our benchmark because we've had these conservative managers, because you've been paid to be down in the triple Cs and the more risky stuff because they didn't default. Now that you saw very briefly during COVID, our managers outperformed because everybody was panicking that we were going to have a huge wave of defaults, and they were cleaner than the rest, but then that pretty quickly, reverted back to what it had been before when the Fed stepped in to bail out. So, I mean, just kind of to point out that, you don't know until you really go through a difficult default cycle, and I don't think we've been through one since, 2009. So
we agree with John that your asset class structure was built for a more normal default cycle and not what we've experienced in the past. Because what we've experienced in the past is that's quite unusual. But the only other thing I'd comment on is that the actual loss to a portfolio is one, the actual number of defaults and their magnitude, but also there's a recovery aspect to it. So when you're on the conservative side, you're typically investing in companies where if they do default, they typically have assets that maybe you recover some larger portion of the debt capital that you've invested. So it's a two-part equation as to how much the portfolio suffers from a default.
In terms of default cycles, a couple years ago, the default rate was not real high. It kind of ticked up a little bit, but half of that was from energy companies. And so the market right now, there's no single area that's kind of teetering on the edge of default as it was with energy a couple years ago. We came out of that very clean. So, all right. Preferred securities on page 7, also known as preferred stock. Why are preferreds considered non-core? Well, understand a little bit about the structure of a preferred. So the companies that issue preferred securities are largely investment grade. So why is there a lower credit rating? And it comes from not from the higher credit risk from the issuer, but what we call subordination. That is where the security sits in the capital structure on a company's balance sheet. With respect to preferreds, they sit below senior debt, so that the lower credit rating is due to that lower position in the capital structure than would be senior debt. But I would add too, about 2/3 of our index is investment grade. So there's a blend of investment grade and high yield issuers within this area. Preferred securities really is dominated by banks and financials. Banks have regulatory capital requirements to maintain certain capital ratios, and preferreds are an effective way for these companies to manage their capital ratios, keeps their debt to equity levels lower because part of it's not all treated as debt. It doesn't give away voting control to common shareholders like if they issue common stock. So it's an effective way for these banks to manage that aspect of complying with the regulatory requirements. One big difference though with preferreds than the other areas in non-core fixed income and with a lot of fixed income more broadly is that preferreds pay a dividend and they do not pay coupon interest on a bond. That means the preferred dividend is not contractually obligated like coupon interest would be on a bond. But also to realize that if a company suspends its preferred dividends, that is a bad sign. They don't do this just because they don't feel like paying the preferred dividend this quarter. It's not something they just turn off and turn on. It's suspending your preferred dividend is a signal of stress.
Is there a requirement in these preferred securities to pay a dividend? I mean, is there some, not just an expectation, but is there a requirement that they pay the dividend?
There's no requirement. With respect to dividends more broadly, they cannot pay dividends to the common shareholders until they pay the preferred dividend. So there's no contractual obligation for them to pay a dividend. But there are other reasons why they would want to.
And can that dividend fluctuate depending on?
It's a fixed rate.
It's a fixed rate.
Yeah, fixed rate. Well, we'll get more into the structures. There are different types, and some are. It gets more complicated. We'll get there at the bottom of the page. So the three different types that we have in our portfolio more broadly. So first would be over-the-counter preferreds, also known as institutional preferreds. They have $1,000 par. There's the $25 par preferreds, also known as a retail or exchange traded preferreds. They cater more to the retail investor. That explains the low par value for that type of security. And last would be contingent convertibles, also known as COCOs. So some of the differences, these types of securities, so duration or interest rate risk. The retail preferreds typically are perpetual. They have no maturity, which means they, although they can be called, but that means they have much higher interest rate risk. Well, as part of managing that risk, we have a relatively small amount of our portfolio invested in this type of security. More common, we invest in over-the-counter preferreds or institutional preferreds. They have a $1,000 par, as I mentioned. So these will have a reset feature, and there are a couple different structures they can do that. The first would be what they call fixed to fixed. So they issue the security with a fixed rate that then resets at some point in the future, typically it's 5 years, and that resets to a different fixed rate based on the prevailing US Treasury rate at the time. And they can do that, say, every 5 years. They can also call those typically at 5-year intervals. The other type would be fixed to floating. So the security is issued with a fixed rate dividend. And then say 5 years into it, it adjusts to a floating rate. This would be over a reference rate like SOFR that you hear about. So those are two different types of how the rate may change. It may change to a fixed rate, it may change to a floating rate. in that type of security, the over-the-counter type. With COCOs, these are largely European bank structures that were created in the aftermath of the GFC. So if a bank's required capital ratio falls below a certain level, then the value of that security is typically written down. There are different ways of doing that, but just think of there would be some kind of impairment to your investment if the capital ratios are not maintained at the required level. But these are also these are denominated in US dollars, so there's not currency risk that we're taking on in our pool. So we have a blend of all three types. Our strategy benchmark is a blend of 60-20-20, so 60% over the counter, 25 or 20% retail, 20% COCOs. So any other questions about preferreds? I know that we got pretty complicated pretty quickly into this type of security, but I think the biggest things to take away is blend of investment grade and high yield, and two, the sector concentration, that there is a large exposure to banks and financials, this type of security. Here's slide 8, emerging market debt, also known as EMD. So first, with respect to emerging markets, there's no standard classification system in the investment world for determining what is and what is not emerging markets. So for international equities, we use the MSCI classification system. That is, MSCI is the benchmark provider for international equities asset class. For emerging market debt, the most widely used indices are from JP Morgan, and so we use that classification system for determining emerging market, what is emerging markets and in terms of emerging market debt universe. Issuer types, these are government bonds, also quasi-government issuers. So quasi-government, think of it as a company, typically is defined as a company that the government owns more than 50% of, or either owns more than 50% of the voting rights. Sometimes this will be an explicit guarantee from the government to back these bonds. Otherwise, in cases it might be an implicit guarantee. A lot of these are energy companies, like national energy companies, as well as banks. And although it's not in our benchmark, we do allow our manager to invest a small part of the portfolio in corporate bonds. There'll be corporate bonds of companies located within the emerging markets region. Within EMD, two broad categories. So if you think of hard currency and local currency, hard currency would be bonds issued in US dollars or also euros. I think about 80% of the hard currency market is issued in US dollars. Local currency bonds are issued in the currency of the issuing country. So for a Mexican government bond, it will be issued in Mexican pesos. Local currency bonds have tended to have higher volatility and lower returns than hard currency bonds. But when we were looking at hiring a manager for emerging market debt, we wanted to have exposure to local currency bonds because there are some times, some periods, and this has been the case more recently, where local currency bonds outperform hard currency bonds. And so the way we decided to do it was to have a blend of hard currency and local currency, and we decided that to have a 70-30 blend, 70% hard, 30% local, have exposure to those, but also to have the blend at the right in the right proportions, given the differences in volatility between the hard currency and local currency bonds. So why do these carry lower credit ratings? Higher economic volatility or economic risks, political risks, currency risks. But again, like prefers, there's a blend of investment grade and below investment grade issuers. About 60% of our emerging market debt index is in investment grade. With respect to interest rate risk, maturities vary. So these are government bonds, like similar to you would see in US Treasuries. So these maturities vary widely. Duration isn't necessarily that much different than what you would see in US core fixed income. So a little more interest rate risk than some of the other areas within non-core fixed income. Any other questions about emerging market debt?
Just to go back, so you got some local currency in the emerging market debt, but did you say that the preferred securities are all dollar-based, US dollar? Okay.
Yeah. There may be preferreds issued in other currencies, but our guidelines with our manager are all securities have to be denominated in US dollars.
Kind of follow up on that. Do you see, as far as like the hard currency, local currency, was it the 80-20 US kind of across the market?
Yeah, I think mostly euros. I don't know if some maybe
Or
issued
US
in
or
maybe Japanese yen, but really US dollars.
Do you see that shifting any? I mean, because you hear about kind of the shift with China and Russia away from, we're trying to push away from kind of US as a reserve currency. Do you see that potential for that market to shift over time?
It's not something we've heard from our manager or seen in terms of the portfolio. Does it seem like there is a move away from issuing in dollars versus euros? Okay.
There have been a lot of stories about that, but the way you track the reality of it is by looking at international sales and purchases and what currency they're in. And the renminbi, the Chinese currency, has not made much progress. A lot of talk so far. John likes to use the phrase dirtiest shirt in the closet. The dollar, the dollar still is. So there is an actual data check on those stories, and so far, the U.S. dollar is still the reserve currency of the world.
And two, based on what Jim was referring to, the reserves that countries will have still largely in US dollars. And if you're going to pay US dollar bonds, you better have some dollars to pay them. And so that follows. Slide 9, convertible bonds or converts. The convertible refers to convertible into equity. So at the basic level, the value of a convertible bond is the value of the bond portion, which comes from the coupon interest payments. This is contractually obligated by the agreement of the issue, as well as the conversion feature, which is like an equity call option. Without getting too deep into equity call options, it's like betting on the price of a stock going up. So the two together create that value for a convertible bond. The coupon interest payments for convertible bonds are typically lower than other areas of fixed income, but investors are willing to invest in that because they have greater upside that comes from the conversion feature. Why do companies issue convertible bonds? Well, most of the issuers are young, faster growing companies. A lot of technology companies and healthcare companies in the convertible bond issuer universe. So issuing straight debt means being saddled with relatively high interest payments that if you're a young company that's growing quickly, you can put to better uses than paying interest. But also too, if you issued equity, you would dilute your current shareholders. So one way for these companies to try to balance that is to issue convertible bonds, which they can raise capital that lowers their interest burden, but then delays any potential dilution of common shareholders at some point in time in the future, which presumably will be less of an issue.
It also allows founders of small tech companies and their VC backers to continue to control the company because convertible shareholders don't get to vote.
That's right. So that conversion feature comes with more equity sensitivity. So there's more equity sensitivity in convertible bonds than the other security types within non-core fixed income. Our approach is more conservative with more of a focus on credit research and downside risk management. So our portfolio will have less equity sensitivity than the market. I would add too that for most issuers, this is the only debt on their balance sheet. That means that most of the market is not rated by any rating agency. About 80% of the convertible bond market is not rated. Companies that are rated typically are investment grade companies. Insurance companies tend to be active in the convertible bond market, and they have certain obligations to invest in companies that are rated. So a lot of those securities that are rated tend to be more investment grade issues. So in summary, more equity sensitivity than other areas of the non-core fixed income asset class, but very low duration, low interest rate sensitivity coming from the low coupon payments and shorter maturities. 5-year maturity is pretty common for convertible bond. Any other questions about converts?
So do you see that option being exercised relatively frequently? 'Cause it's just kind of funny because it's high yield debt, and so it's
It's
debt, and then once it
one of
converts,
the
now
questions
it's
that
equity.
when we were looking at convertible bonds, if you ever convert it, no. The value of the convertible bond is the bond value plus the conversion feature. And if you convert, you just have equity risk. And so that's not something they're really looking for. So there are certain types of converts that are mandatory convertibles. They have to convert, but that's not something that our manager plays in. They have different types of profile to them. That's just not attractive, not something that we actually. Slide 10 shows the current portfolio. This would be the list of our managers, the performance track record within the pensions, within trust fund, within state fund. Again, as a reminder, the pension funds have allocation to non-core fixed income, all the 4 different security types. Trust fund and state fund have allocations only to U.S. high yield bonds. Any questions on this page?
Yeah, didn't we approve state fund to convertibles, or there was a discussion?
We
about
did. That was at the February meeting, so you remember we had 3 requests essentially, change the benchmark for fixed income to the ag rather than the intermediate ag. Added converts and we added real assets.
Okay.
So we have been much more focused on getting the duration up towards the ag, as we'll talk about in a little bit in the investment update, and getting some of the real asset stuff on the ground. We've been talking to our convert manager, who, as you know, we just funded fairly recently. We'll get there eventually in state fund, but I'd say it's a lower priority than the other 2 right now, given their cash flow constraints.
There is, in the IPS, there is a allowance for that.
Yes, there is.
Any other questions on page 10?
So across these managers, you got multiple high yield managers, and you're talking about diversification, like each manager is managing their own diversification. But do you seek out managers that are like focused or on different sectors of the high yield universe, or or you just kind of let them overlap?
No, I think the high yield universe is not enormous, and I've come across managers that are more concentrated, that have fewer issues, that take larger bets, but not any that only play in certain areas of the market.
Yeah, so most of them are just kind of across the space.
Yeah.
It's not
Just
energy or.
Yeah, and part of the reason with why our approach is the way it is, a lot of places in investments people can chase returns. And in fixed income or in high yield bonds, if you're looking for the latest hot thing, it's been at the top of the peer group. When that turns, it can get ugly. That means they're getting defaults, impairments, and what was the top performer in one period might likely be the bottom performer next. So we're looking to avoid that kind of risk profile, avoid defaults as much as we can, and a much steadier performance track record and return profile. Slide 11 shows some of the exposures. At this point, to a few things that stand out. First would be, if you look at in terms of the sector exposures, we have more in banks. That comes from our exposure to preferred securities. We have exposure to hard currency sovereign bonds and local currency sovereign bonds. That comes from emerging market debt. These are not included in the U.S. high yield index. If you look at credit rating exposure, again, we are higher quality credit with our exposure to preferreds and to emerging market debt, having some exposure to investment grade bonds. So that the triple B or higher would be investment grade, and really that's not included in the high yield index. As well as if you look on the right side of that chart, upper right hand, the non-rated or non-classified, we have a higher percent of that comes from our convertible bonds, which are largely not rated. One other thing I'd point out about this this chart is if you look at the double B exposure for the benchmark, that it's kind of in the mid-40s, has been close to 50%. That is a very high level relative to history. So if you look at the total quality of the high yield market is about as high as it's ever been. Then page 12.
You're saying that's on the benchmark, right?
Is that?
The benchmark is at a higher than it.
Yeah.
But if we're in triple B, then we are even at a higher quality than even the benchmark. Right?
Yeah, so, and that, like I said, that comes from the areas in preferreds and emerging market debt, which do have a blend in their strategies of investment grade and high yield. So we do, if you look to the benchmark, which we have to have mentioned to something, but we will have a higher credit quality relative to the index.
So I don't know if, I don't remember who all was here when, but the benchmark discussion, we love to have them, of course, but you will remember maybe that when we decided to kind of diversify within non-core outside of high yield, we could have, of course, said, well, we'll have the emerging market debt benchmark and the preferreds and the converts and the high yield, and we'll blend it all together based on our weights or something. I just kind of said, no, we're just gonna benchmark it to high yield. Yes, that creates tracking error here, for better or for worse, I guess, but I think it's reasonable. We're looking for a high, fixed income return here. If you look at the yield right now on, say, emerging market debt or preferreds versus high yield, they're in that ballpark, and I think over the longer term, we'll probably see similar results, but in different periods of time. So, we just didn't make it more complicated, I guess is the.
And you're okay with that, Jim?
Well, it's a good point. I was about to say that this is, and I'm looking at this as from the perspective of RBK advising the board, not the staff. This is a more challenging area for the board to judge how the staff is doing, because it is, the geek term is benchmark agnostic. They're not trying to hit a benchmark. The benchmark can't be duplicated. There's no product in this area that you could track it. It's just not reasonable. So they have essentially what you might call aspirational or pragmatic goals for these exposures. And I think that two things. One is that, and so it's harder because there isn't a benchmark. Our portfolio exceeded it or didn't or whatever. High yield is a slight exception, but even there, you've structured your high yield to be almost benchmark agnostic. So I think that in reviews, it's important for the staff to say, here's what our expectations were and why they were justifiable, why they're not too low. And here's what came about. Here's what we expected the contribution of these benchmark agnostic, non-benchmark areas to the portfolio. And we'll do the same. So far, the strategy, while it's still in its infancy really, has proven out pretty well so far. And is thoughtfully structured. But this is I think your point is that this is a harder place for the board to judge how well are we doing.
To be clear, I was not asking for a blended benchmark. But it goes back to the point I made, at the start. Why do we have these? There's the strategies we have in there have some level of return and income that we think is attractive relative to the risk of the volatility. And we think that can be additive to the portfolio, as opposed to, we're only going to add things to this asset class that can outperform high yield bonds. That's not.
But that's a very good point, because that is one benchmark that you could look, in the same way that when you look at private equity, and we'll talk about this in a minute, if you don't see a premium to public equity, something's not quite right. And if you look at non-core fixed income, because of the complexity and the additional risks you're taking, if you're not getting something more than plain vanilla bonds, why are you doing it? So there at least there is something to hang the board to hang their hat on, to say, yeah, we're getting something for this effort. Is that a fair comment?
What is kind of just kind of a generalized yield on a, double B rated high yield bond right now, or what kind of?
So
return?
the yield for the high yield market as a whole is a little over 8% right now. So it'd be somewhat less than that for double Bs. And one of the reasons you see that, why do we have, at least on our high yield managers, have an underweight to double B bonds, a lot more duration. A lot of double B includes what they call fallen angels. These are companies that were investment grade that have fallen to high yield. They come with longer maturities and more interest rate risk. And our managers look and say, well, they're yielding less and they have this much interest rate risk. I think the single B rated space is more attractive. In high yield, they typically call it the single B sweet spot, that you're getting a little more risk, a little more return, but not so much risk as you might in triple Cs and not lower yields like you would get in double Bs. If you look at page 12, I thought it'd be helpful to show a longer term comparison of the asset classes within non-core fixed income, using some of the major benchmarks as proxies for these strategies. In the first column, you see the annualized returns. It's going back a little more than 20 years. Next column would be the excess returns over core fixed income. So that is the returns of the strategy minus the returns on the Bloomberg US aggregate. Next column, standard deviation, just measuring the volatility of returns. And the last column, Sharpe ratio. Sharpe ratio is basically a risk-adjusted return metric that compares a investment's return to its volatility. So I've included to the core fixed income and domestic equities. I think if you look at this page, what do you take away from it? Higher returns for non-core fixed income than core fixed income, but higher volatility, but lower returns and lower volatility than stocks. So I think that's kind of where non-core fixed income sits.
Now, these aren't duration adjusted, right? So there's the durations of these categories differ somewhat. So that's kind of, there's a factor in here that kind of messes a little bit, but the message is still the same.
Yeah, so I'm glad you pointed that out. So the preferred securities, our database only had access to the preferred securities benchmark, or the $25 par benchmark. I mentioned the $25 par type of security is perpetual, the highest interest rate risk. So this is the most volatile part of preferreds with, and probably the low returns. What you would see from the over-the-counter and COCOs. COCOs are relatively newer, don't have as long of a track record, but a very different risk return profile than what you see and what we've used as a proxy for preferred securities.
And the way that is expressed here is if you look at the annualized returns versus the standard deviation, it's the worst mismatch. And I presume it's because of the duration. But it's also the smallest part of your target universe for your preferred allocation, correct?
It's the smallest part of the benchmark allocation, and we are underweight as well. So we have even less of this type of security than does our benchmark index. Page 13, a few comments on today's market. Market's now providing higher yields after having been through a long period of very low interest rates. So the positives for high yield, so you'll hear me refer to spreads. I think they had talked about it in the fixed income, the core fixed income presentation. High yield spreads, that's the incremental return of a high yield bond over comparable treasury. It's kind of a valuation measure. Wider spreads means higher yields, lower prices. Narrower spreads means lower yields, higher prices. Today's spreads, which would be a little less than 400 basis points, I would call it kind of a normal range. It's not screaming incredibly overvalued. It's not saying there's stress or distress in the market. Pretty much a normal range for spreads. So we have higher yields for high yield bonds now, like I said, over a little bit over 8%, which is pretty attractive, especially considering it's above the pension plan's actuarial hurdle. I mentioned too that there are times in the market where there are potential for capital appreciation, even though these are income-oriented strategies, but the U.S. high yield bond market is trading at a discount to par. It's trading in like upper 80s, 90% of 90 cents relative to $100 par. So as these bonds mature, there's potential for extra return. So we get paid off at par, and if we're paying 88 cents for a bond, we'll get paid off at 100. Defaults have been very low. They picked up just a little bit. Typically, what triggers defaults in a lot of cases is a maturity. So a company is having some kind of issues, or the market is closed, and they're trying to refinance their debt and they can't. They then need to default and bankruptcy, go through a restructuring. The maturity schedule in the high yield bond market is pretty weak for going out to about 2027. So if that's a risk of triggering defaults, that's pretty low level risk, at least for a little while now. Companies tend to refinance well in advance of that maturity date, but that's one area where you would expect maybe defaults will continue to stay low. But so I mentioned some of the positives. Some of the concerns would be, really the biggest concern for high yield would be what happens if the economy disappoints. Defaults increase, spreads would widen in that case. That really, I think, is the chief concern, which is interesting because we talked with our managers, high yield managers too, about strategic investors and tactical investors. Tactical have been a little bit more cautious on high yield because they think, well, the economy's going to be weaker, and so spreads are going to widen. The more strategic, like, well, I've got time, and 8%, a little over 8% looks pretty good. I'll take it. So for preferreds had lagged largely due to, we talked about the issues in the banking system in the first quarter this year. A little bit more of a rebound in the second quarter, but largely for the last year to date and for the last year, preferreds have lagged the other types of strategies within non-core fixed income. Emerging market debt, after having kind of a tough period after we hired our emerging market debt manager, has rallied back and has had strong returns year to date and over the last 12 months. I think the top performer of the different strategies within non-core fixed income. Local currency bonds have done very well. The question would be any concerns about what's going to happen to the dollar. A lot of people have been calling for a weaker dollar, but if that hasn't really played out in every case, and if it stays strong, then that might be a little bit of a headwind to local currency bonds. We added to our preferred allocation in July, as well as emerging market debt. We added to convertible bond manager more recently as well. So we've made some allocation within non-core fixed income to preferreds, EMD, and converts. For the convertible bond market, we funded in March. Like I said, we added to it more recently. Some of the positives would be there are different types of issuers coming to market, which I mentioned that convertible bond market is heavy in technology and healthcare companies. There have been different types of issuers. And our feedback from our manager has been that in terms of building a portfolio that's diversified by sector, this is as good a time as you've seen in 30 years, Coupon rates are up. I mentioned that convertibles typically pay a low level of coupons. When things were hot, there were some convertibles that were issued with a 0% coupons. Coupon rates have increased, and so that's another positive. There's also been a little bit of pickup in issues from investment grade issuers, which we've participated some in, and that's another way of diversifying the portfolio that maybe wasn't available in some of the more recent years. Any other questions on the state of the market? Any of these I didn't answer. So 14 here, to summarize, I spoke to all these points really. The objective of the asset class to return, get returns higher than core fixed income, what we're looking for in terms of diversification, the strategy focus we have, why we're conservative and high yield, why we have a blend of hard currency and local currency within EMD, the flexibility we've given our manager with the preferred securities, why we have a conservative approach to the convertible bonds, but be glad to answer any other questions. Just quickly point to slide 16. This is a slide provided by our manager that has a lot of information. This is referring to high yield bonds. But there's a lot of information on this page. Very helpful. I always like to include this in our asset class review. But be glad to answer any other questions you might have.
Question? If not, thank you, Jason. That was thorough. And so,
He's really good at throwing pies in the face. Come up for air once.
well, and I want to say that the board was pretty good right after lunch. And so do you want a stretch break or we want to?
I think we should just given 4 o'clock commitments by a bunch of board members, why don't we roll? And if you need a stretch break, just go get a stretch break.
Okay.
Copy and
So that's what
Jim will
we'll
tell us how awesome we are for last fiscal year compared to all of our peers.
just remember,
Chair,
Jim,
would you like me up there? Whatever is your pleasure.
I think you're good there.
Okay.
That's, we'll see how you do.
I just fear that if I go up there, that probably is another 1,000 words that you.
Oh, well.
Yeah.
Mr. Chair, I would
Well, you
submit
know, that's what a podium does to people.
more than 3 analogies and he has to go to the podium.
I'm going to be working quickly here because I thought I was on tomorrow and I didn't know that until I got off the plane that I was on today. So, but I'm ready. But I always like to start off by just sounding a few themes that occur to me, and John and staff may agree with some of them, they may not. But, you know, we do a lot of board meetings and we do a lot of reviews. And I thought I'd mention a few things that affect all institutional investors and this fund as well. The first thing I'd like to say, though, is housekeeping, and that is that if we are so fortunate to get the chance to host this board in a day-long event where we can address things that are of interest to you, we'd be excited, whether it's in our Boise office, our Portland office, we don't care, we'll find you. But I would really encourage you to talk about coming up for air, to think about the last 3 or 4 meetings and say, you know, what am I still trying to get my arms around to understand from my perspective as oversight of this portfolio and understanding what it's doing and understanding the staff's execution of the investment strategy. So, you know, there are no bad questions and there are no bad topics, and I'm sure Dan will solicit them as well as John. The second thing is that I'd say is John is and Dan are exactly right. I mean, the numbers speak for themselves. The fund and its investment strategy, quite frankly, is just performing well and continues to do so. And in no small part, that's because of good structure, constant incremental, I don't want to call it tinkering because that sounds like a hobby. But thinking about ways to improve the structure without sort of wiping the slate clean and starting over. And I think our discussion in Portland on asset allocation was a great example of that. You know, testing everything that was being done and saying, well, should we wipe something out or not, or change it in a material way? And I'll point to some numbers very briefly that will back up that statement that the fund and its investment strategy are performing well. That doesn't mean that every single aspect of the portfolio is like spinning like a top. Take international equity, for example. You're actually beating your benchmark. That's good. You're beating the passive alternative. Are you beating it by as much as peers? How much do you care about that? That's one aspect, and we'll talk about that in a little moment, but I would call that, a small world problem, if it's a problem at all. Nobody in this room is old enough other than me to remember a guy named Yogi Berra. Yogi Berra was a great baseball player, Hall of Famer, and he had a lot of quips, and he's attributed, a quip is attributed to him, which is, it's deja vu all over again. And so the theme of my opening remarks is it's deja vu all over again, well, almost. And what by that I mean, let's look back at the last 10 to 12 years and what's happening as we speak today. That's very, very similar. So one, US equity is once again pressing up toward historical high valuations, despite the fact that people are worried about recession, despite the fact that the competition for investor dollars from fixed income, including non-core fixed income, is much stronger than it has been over this period. But there we go. US equity is once again punching up above in the top 20%, 10% of its historical range. Very similar, deja vu all over again. The second thing is US equity is once again outperforming international equity. There was a brief time there where international equity actually exceeded returns for a brief time of US equity, and an equally brief time where it kind of was in the same ballpark. But now it has fallen behind again. Again, very similar to the last 10 plus years. US equity has dominated the US equity index and its performance, and you are heavily indexed in domestic equity, almost exclusively, in fact, exclusively, is dominated once again by a handful of stocks, where when you see that index go up, what you're seeing is really 7 stocks go up. The rest of the stocks, the other 593 are pretty much going sideways net. And so it's becoming once again a very concentrated market. You'll remember the term FANG. Well, now there's a new term and I can't even remember what it is because it's the population of those 7 stocks, and I'll show you some statistics in a moment, have changed. But what we have learned from 2022 is that when something occurs that affects the discount rate for these 7 stocks that are driving the cap weighted index up, that because there's so much of the index, they can take the index down quickly, and that's what happened. So there's concentration risk in the index. Now, is that a reason to rethink your use of passive in the domestic market? No, it's just it just brings a point home that the index isn't always the very best place to be, but it is the simplest place to be, it is the cheapest place to be, and it is the place, particularly for large cap equity, where you have the least probability, if you were to go active, of actually improving your situation. So, but there is no perfect thing, and cap weighted indices, particularly when there's this kind of concentrations building, it's a risk, and it should set your expectations that the cap weighted index that you have placed your domestic equity exposures in is not a be all and the end all. It has its ups and downs as well. Another thing is that that's the same as the last 10 years is fixed income contribution to total fund returns is minimal, but it's not minimal. It's minimal temporarily, and I'll get to that in a moment. But it's minimal compared to equity, as you see in the performance book. So if it's all the same, why do I say it's deja vu all over again almost? Because there are some big differences. One is that interest rates are much higher. I mean, they are substantially higher. And that means that when you see equity go up, whether it's international equity or because the central banks globally are also raising their rates, or in the case of Japan, are allowing rates to gradually rise a bit. It is a competition for capital, and I will say that among our 200 plus clients, there is a serious conversation going on about should we stop reducing our fixed income exposure that we've been reducing for a decade now because it's been so unremunerative to the non-contributory to the fund, and should we start raising it again? And some are. You have never abandoned fixed income. You have always had a role in the portfolio. So I think that the issue for you is not nearly so, do we do something completely different, which I think is something that came out in the quarterly discussions as well. Another thing that's different is the yield curve's inverted now. So that makes a big difference in terms of, and you heard my questions of your fixed income folks, the reinvestment risk issue is a challenging one because you're so tempted to go to the front end of the curve and get 5 and 6% with no brainer. The problem is that if the curve uninverts and goes to its normal style or shape, you have significant reinvestment risk. You have, again, played it conservatively, or your staff has played it conservatively by having a duration that isn't a big bet one way or another. But there are investors out there that are loading up on the front end. They're basically making a bet that that front end will stay higher than the long end for a long period of time. They're going to have to be very, very nimble to sense a change, because when those changes happen, they happen very, very quickly. And so that's different. The third thing that's different is that the US and the global economy is slowing. Now, over the last 10 or 12 years, it has waxed and waned and waxed and waned. But I happened on a statistic that's in the book, and it's too buried to point it out. But it's a geek metric called the Baltic Dry Shipping Index. And it basically it puts oil aside and it asks the question, what's happening to rates and cargoes internationally? And it is going down like a rocket. And that's not a good sign for the global economy. And that's different than what we've seen before. And you've probably read in the Wall Street Journal and other places about the potential for deglobalization, and that is onshoring, and globalization has been a driver of US economic growth as well as global growth. That's different. We just had a discussion of default and credit risk. We have a situation now with higher rates where, as John and I were talking, and John mentioned, I think as well, that we've had low default rates because if folks have run up against the need to pay back debt because it's matured, they had easy access to new debt to roll it over at roughly the same rates, plus or minus 1%. Well, now it's plus or minus 3 or 4 or 5 or 6%. And that's a huge difference between what's faced now and before. And the other thing that's interesting is that real estate, which was the surprise positive of COVID, it really was the surprise positive of COVID, in the sense that so many bad things could happen to office and retail, and yet the other parts did so well that the real estate market, or real estate exposures actually did quite well. That's not so much the case now, because the good parts have been repriced up, and the bad parts are suffering just as much, if not more, particularly Center City. So those are all different, and they paint a different backdrop. So let me just run through a few numbers, and I'll be working from the executive summary that the board has in front of them, and not the great big book, because the great big book would cause me to talk too much, and then the chair would be very upset. We can't have that.
Exactly.
Yeah.
And they said you weren't trainable.
No, only Becky said that. Oh. Paige says I'm very trainable. That's because I listen to her. So just a couple of numbers that I wanted to point out.
What page are you on to?
I'm on page 5. And I wanted to talk a little bit about inflation here. If you're on page 5 of the executive summary, you see a chart up on the top of the page. And it's kind of got this green coloring that goes through, which is headline CPI inflation. And you can see how problematic that bulge in inflation is. And I think there's this notion that, well, if it went up, but if it comes back down, all the bad things that it did go away. Not so. This is damage. This is damage to the capital markets and the economy. It doesn't go away. It just stops getting worse. And knock on wood, it stops getting worse. But what's interesting here is if you look at the dark line, that's expectations for inflation that are built into the TIPS market. Hardly a change through all of this, whether it's whether inflation was well behaved and almost monotonic, including the bulge. There was a little bit of an increase, and you can see that in the table below, where it has break-even inflation about a third of the way down that table for 5, 10-year, and 30-year TIPS. But you can see that back in Q4 of 2022, the numbers just haven't changed that much in terms of the expectation that the TIPS market, remember this is Treasury inflation protected securities, if you compare those against non-inflation protected ones, you get a sense of what the market is expecting for inflation, because that's the key difference between those two securities, those two investments. It really hasn't changed that much. And it is, so far, it's very much in line with our expectation of inflation of about 2.5%. The Baltic Dry Index shipping number is there, and I just wanted to point out that look at the 10-year average, look at the last, look at quarter 2022, look at quarter 1 2023, and look at the current quarter, the most recent quarter. You see the decline? That's a very big decline in a single quarter over quarter. And it just caught my eye as I was looking through it. I hadn't really focused on it before. And the last thing that I would say is that, a lot of folks have pointed to the PPI, which you see is the only red number there, which is actually disinflation and a reduction in prices as a harbinger that the Fed's job is almost over. It might be, but again, a lot of that is driven by the next to the last line where you see oil prices go from 80 to 71. And so, we know that oil prices can be highly volatile, so we don't want to get all that excited about the PPI as spelling the end of inflation. If I could turn to page 6 for a moment, really interesting, and it's something that I've talked about in past times, and that is that the total fund composite for 3 years, 5 years, 7 years, 10 years has been executed well versus its benchmark. Now we can, sort of go back and forth about, was this the best benchmark? Is that a great benchmark? But over time, particularly over longer periods of time, benchmark construction, if we're quibbling on the edges, becomes less and less important, and the consistency of the execution of the program starts to stand out. And this is one of those periods where we look back 3, 5, 7, and 10 years, and the difference between what the fund has done and what the fund would do if it did invested only in its benchmarks is quite positive. What's interesting here is the ranks. So one of the questions, and I call this the Zen conclusion, how can the Montana Board of Investment be in the fifth percentile of all institutional funds in its general category, its peer category, when none of these numbers is even close to the fifth category? I mean, is that a typo? The answer is no. The answer is that the more consistent you are in not falling below median, but staying above median year after year, where peers can cycle above and below median, volatility is the enemy not only of returns, but it's also the enemy of peer rankings. And your performance has been so consistent that You know, you don't have to ever be in the top decile in any year, in any 3 years, in any quarter, it doesn't matter. So long as you, most of the time, in fact, almost all the time, because we've been with you through this period, you're above median. It accumulates, it's a cumulative thing. And you should be very proud of it. Now, I will caution that you've heard me say many times, of the 3 comparisons that you should care about, that's the least important. Because who cares what peers do? They don't have to pay your benefits. They don't have to finance the distributions from your trust fund, et cetera. But that said, even when you look at the three descending sort of how are we doing questions, if you look at 3, 5, 7, and 10 years and compare it to your current actuarial expectation, that is your driver of what contributions should be based on your actuary's assumptions, these are good numbers. And those are really important. If you look at your execution, again, I just commented on, those are good numbers as well. So your rankings are a little bit like icing on the cake as far as I'm concerned. Nice to have, but you'd never trade a good ranking for, you know, a horrible gap between returns and your actuarial assumption that sets your contribution rates and your funding ratios. With that, and interrupt me with questions because I'm moving fast because I'm watching the chair and I know he's going to go like that at any moment.
When I start watching the clock. And
if you turn to page 7, here's another interesting anomaly that has to do with returns versus peers. Now, when you get past total fund and you start looking at peers that are doing more and more like what you're trying to do, not exactly, and that's why peer comparisons are never sort of the be all and the end all, but the more homogeneous the peer group is in what it's trying to do. Say, for example, take small cap value managers. They're all working with the same set of stocks. They're all working with the same set of accepted methodologies. They may differ as to which one they put the most weight on and which one they use. Then all of a sudden, peer rankings become a little more informative. So when we get to asset classes, they become a little bit more informative. And let's look at domestic equity versus international equity, because you're more active in international equity, although you're substantially indexed, and you're entirely indexed in domestic equity. If you look at the recent period of time, what you'll notice is, and we're going to talk about this in a minute, that concentration risk that I talked about in the large cap indice, and therefore in the passive vehicles that affected it, is one of the reasons why you see some red numbers here in your domestic equity. It's not a terrible thing. It just is what it is, and I don't think it militates against your strategy. But one of the interesting things here is that if you look at your rankings against peers, which start to have a little bit more informative attributes to them, your rankings are very high in terms of what you're doing, your strategy versus what other investors in this class are doing with respect to their approach to trying to get returns from domestic equity. Now let's drop down to international equity. Several things pop out. One is that there was a brief period of time, you can see it in fiscal year to date numbers in particular, where the international equity returns pushed up much closer to domestic equity over a period of time. But that obviously has faded in recent times, and it certainly wasn't present over the last 10 years. What's interesting here is that you have good execution, pretty good execution. Only the 3-year number is below your benchmark. But when you look at your ranks are very low. Now, again, I would say, do you care? That just means that there are other peer institutions that are being very aggressive, probably with active strategies, and they're doing well. God bless them. But the point is that you're still doing better than the index for most of these periods of time. So is this a problem or not? I would say not necessarily, unless you have this, you're just this, unless you put competition against peers at the top of your to-do list, and we would advise against that. So.
Maybe just one comment real quick,
Yep.
Jim, just for the benefit of members that haven't been here as long. In domestic equity, we went fully passive about 2 years ago or so. Prior to that, we were, I don't even remember, I want to say maybe closer to 50-50 passive active, and maybe, don't remember exact timeframes, but probably out more towards that 10-year number, we were probably even more active. So we kind of got progressively more passive over time. A couple of years ago, entirely passive. So there's kind of a blend of things going on with domestic, but just wanted to point that out.
So as compared to international, which is more active?
I would say the international hasn't changed as much over time. You know, it's kind of that roughly 50-50 active, passive. Maybe we've started to look a little bit more active there, but we've always been in that, more in that ballpark with international.
And with the exception of that 3-year, that 1 3-year rolling period, you have actually gotten some value out of the active part of that mix. So, if I could turn to page, Chair, I'll only do 2 more pages, or 3 more pages. And then I'll stop for questions. But I think there are a couple of more comments that I wanted to make. You've heard me talk about the shape of the yield curve. And of course, everybody understands the yield curve is sort of where the treasury yields are for 3 months, 6 months, 1 year, 2, 5, 7, 30. And if you look at the lower right-hand side, you can see how massively the yield curve has changed from the page 11. Page 11, there should be a yield curve, treasury yield curve chart on the lower right-hand side. We all there? And you can see that in a relatively short period of time, from June of 20 to now here, you know, we're roughly June of 23, in 3 years, just forget all the other colors and just look at the black and the green. What a massive change, not only in the level of treasury rates, because the Fed has raised interest rates at the short end. The Fed can't control long rates, although it can influence them. So the magnitudes have changed, but the shape of the yield curve has changed as well. And with short rates being anywhere from 3 months to 5 to 7 years, being much higher than the long-term treasury bond, 30-year. This is typically a situation in which investors are saying, the Fed's pushing up rates now, they're fighting inflation, but I expect when this is over, rates are going to be lowered, and therefore I am willing to buy 10 and particularly 30-year treasury paper or equivalent corporate bonds with a spread at lower rates than I could with short duration bonds. This is typically a sign of an impending recession, but it could be if there is a soft landing, and we don't know if that's going to be the case. It could be simply a sign that says the Fed can win the battle with inflation, stop raising rates, and maybe let them come down a little bit. Although John and I were talking about, if there's a soft landing, what is the impetus that the Fed would need to have in its dual mandate? Remember, the Fed has a dual mandate: economic growth and price stability. But if they've achieved price stability and there's still economic growth, and the treasury rates and the short end are at 4 or 5 or whatever percent, what's the impetus that they would feel to cut them? That's what puzzles me, and I suspect it puzzles you a little bit too, because we were talking about that. So there's a conundrum to be had here, and it's also a challenge for your fixed income staff, which is why I asked a couple of the questions about duration and reinvestment risk, about how they're negotiating an unusually shaped yield curve that historically has not stayed inverted for all that long. But this is actually probably going to be one of the longest inversions that I can remember, and I've been around for a while. because I'm the oldest guy in the room here. So I think that's worth thinking about. And when you get fixed income reviews like you did today, when you hear the word duration, that's an important word when the yield curve is anything other than its perfectly normal, sort of gradually upward sloping form. The other couple of things that I wanted to mention was, let's see, on the next page, page 12. This is a page that brings to light a little bit about what I was talking about, what happens in passive exposure when there's a tremendous amount of unusual concentration in a handful of stocks. So if you look at the right-hand panel, what you'll see in that little box that's there, forget all this other stuff. I didn't create this. It looks very confusing to me. But the box tells you a lot. It says that in the Russell 1000 growth, that is the 1,000 stocks that are considered the sort of the large and mid-sized growth stocks in the U.S. equity market, 47% of it is in 7 stocks. Isn't that astonishing? I mean, that's astonishing to me. The value, let me just drop down to the S&P 500, which is the one that's most normally looked at. More than a quarter of all the value of the S&P 500 is in 7 stocks. And as I said before, I don't have the statistics at hand, but a very substantial proportion of the gains that you've seen in the S&P 500 or the Russell 1000 this year, when people say the market's up, what they're really saying is those 7 stocks are up a lot. They're also saying that the rest of the market's up a bit, but those stocks are up a lot. And what this has done is created a dilemma for clients that are passive. Should they be worried about this? And the answer is yes, somewhat, because when we had the long discussions about going passive, Becky and I repeatedly said, going passive and going into a cap weight index doesn't mean that you've eliminated your risk. It means you've eliminated your tracking error for the most part, and your downside risk associated with active managers underperforming. But it doesn't mean you've eliminated your risk. And one of the risks is concentration, in that the passive vehicle that is your exposure can be awfully tied to a small number of stocks, which it is currently. Again, that's not an argument for abandoning it at all. But if you go to the left-hand panel, one of the attributes that you see in the S&P 500, I want to look at the lower right-hand corner of that box. There's 2 kind of boxes inserted. One says S&P 500 equal weighted and what its PE is as of the end of that quarter. And the S&P 500 index PE in total, cap weighted. Cap weighted means Apple gets a big weighting, Microsoft gets a huge. It's those 7 stocks that dominate what the S&P 500 index value is. So when it's equal weighted, every stock in the 500 gets the same weight in the index. So look at the difference. The difference in valuation between that is accounted for by just 7 stocks changes the PE of the S&P 500 from when you do it when they're in and when they're only weighted as much as every other stock in there by almost 17%. The PE rises from 18 if every stock had the same weight. Microsoft had the same weight as Cleveland Cliffs or whatever. But when those 7 stocks are in, the index has a PE of 21. It's a big difference. So the dilemma is are the other 593 stocks undervalued, or are those 7, are their prospects so great that they deserve to be the drivers of the S&P 500? If that's the case, that's even more reason not to be too concerned about this. But we do have a few clients that are saying, I want to hedge my bets a little bit. I don't want to make such a big bet. I want to stay passive. I don't want to go active particularly in large cap US equity. But so what I'm going to do is I'm going to leaven that passive exposure and maybe make it 90% cap weighted, which is what it's 100% now, and maybe 10% equal weighted. To hedge my bets that maybe it's the other 593 that are the better bet in the 500. So it is an active decision. In fact, going passive is an active decision. And we're not recommending that to you, but I wanted to lay out that notion of thinking so that it, in hopes that it will deepen your understanding of the passive exposure that you actually have, both its rewards, which are very low fees, no benchmark risk, a lot of reducing the probability of underperforming managers, because this is the segment that has the lowest probability for active management outperforming. Our active passive study that we do each year makes that point. So, but I wanted you to deepen your understanding of what passive actually is, because there are many different definitions of passive and many approaches that are passive-like, but choosing between them is an active decision.
So Jim, maybe I could
Yeah,
make
go
just
ahead.
one point, and steal Jason's thunder probably as he's watching here a little bit, but so remember that in our current exposure, we've got the MSCI US index, which is a little bit broader than just like the S&P 500, not a ton, still very, very concentrated. I completely agree with everything you've said. The other piece we have is we've got we can still over and underweight like our small cap. We have a mid cap ETF, so we do have some levers, and Jason will talk about it later, but we're overweight small cap for a lot of the reasons that Jim has just mentioned. So would agree with what he said, and we have some of those levers, and so we aren't purely tracking this, and many of the reasons he's mentioned are why, because you look at the valuation differential between some of those segments of the market, they are very different, and it has hurt us most recently because these 7 stocks continue to do extremely well.
And you saw it in the most recent total fund performance and equity performance. Again, not an argument against it. And I think John makes a great point that you can either choose not to deal with this concentration, which is a viable response, or there are a number of different ways. Equal weighting, adding a little equal weighting is one of them, but also what he said, which is going down cap size into mid cap and small cap and changing the composition of your equity allocation can also be a hedge against those, what they're calling, I think now, the Magnificent Seven or something. I don't know, whatever. But the last comment that I wanted to make was in the lower panel on page 12, and that is that notice John just talked about there was a period of time where, and I mentioned it as well, when the last set of concentration sort of unraveled and made the cap weighted indices not perform well. Well, this bottom chart on page 12 shows the equal weighted versus the cap weighted. And watch the black line. When the black line is falling, it means that the cap weighted index is doing better. And it's typically doing better because there's either the FANG 7 or the Magnificent 7 or something is driving an important piece of the cap weighted index upward. And to the benefit of this fund, because you are cap weighted for the most part, and many others. But notice that during this period of time that John talked about, where there was some hurt, you notice that the black line turns up, and what that means is that's when the last group of concentrated stocks, some of them fell apart. Netflix is an example, for example. There were several of them that kind of fell out. They're not in the new Magnificent Seven, by the way. And so the equal weighted index all of a sudden outperformed, you can see, for probably close to 2 years, but now it's turned down again. Notice a little turn down. That's the latest, sort of 6 months of the emergence of this new concentration in Magnificent Seven. So I'm not suggesting, nor is our team, that you should necessarily do anything about it. I think John and his crew are doing exactly the thinking and the reacting that you would expect. But I wanted to take this opportunity to kind of delve into passive and concentration and make sure that maybe deepen the understanding of your passive exposure, because it's not fire and forget. It's an active decision and it has active aspects to it. So I'll stop there. Chair, did I stay on time?
You did good, Jim. But we do have time for questions. Any questions for Jim?
Jim, do you see any of these institutional investors, instead of just using something like the S&P 500 or what we use as their index, using a growth index and a value index, and then adjusting between the two over time?
The answer is yes, some do try that. Well, first of all, in looking at an asset class structure, and we like to look at asset class structures just like you look at asset allocation structure for your total fund. There are many clients that have what are called style boxes. They make sure that they have active, or I should say, value and growth and cap size, the same thing that John just talked about. And they use different metrics, but when they roll up and ask the question, how is our equity exposure doing? They use the broad indices, because those are the right indices. I mean, because they capture both value and growth. Now, the second part of your question is, are there managers or are there clients, institutional investors, that try to tactically make bets on growth versus value? And the answer is yes, but a big but. It hasn't proven to be a very sustainable effort. Style, there have been many attempts over my 30 years in this industry from asset managers to create products that are basically tactical style bet, one versus the other, and in a significant way. And it's not been very remunerative. There have been bets that have emerged, a lot of them, because of the long history of growth outperformance in the past 10 years. People essentially ended up with bets, liked it, left them there. Is that tactically adjusting? I don't think so. I think it was, they were just staying with the trend. People it's a real challenge to try to figure out when the style side changes. First of all, the definitions of value versus growth are up in the air as to what really is a value stock and a growth one. And the other is the dynamics that drive it one way or another. One of them we know, which is the discount rate, which is linked to interest rates. So when interest rates go high, that's what caused the last group of concentrated market leaders to collapse, because their PEs were very high and they were dependent on a very low discount rate to price value on those more distant earnings in their growth. And some of that may be happening here in terms of not rates coming down, but people expecting them to. So they're willing to look at NVIDIA, which happens to report today. I didn't see the numbers yet, but their PE is now over 200, I think. So there's a big bet on artificial intelligence, NVIDIA really producing a tremendous amount of growth, and it being discounted not at the current sort of Fed's 5%, but more like 3%. So we'll see. But so yes, so that's a long-winded answer that yes, but not in a very aggressive tactical way. Now, there are core managers who in equity space, both international and domestic, who will say, we don't make big bets one way or the other, but we will drift toward the value side or drift toward the growth side, depending on where we think the best opportunities are. But they typically don't depart all that far from sort of the core attributes of the entire market value versus value and growth together. That's a very common structure. I don't know, John, if you want anything to add to that?
No, I think that was good. Yeah. Okay, so thank you. So I think just for a little break, because that's a lot of information, We'll take about a 10-minute break. We'll start again at 2:30. That's with John promising to move it forward. Got it. Okay. Dan's got.
There you go, now you're good.
All right, we'll reconvene our meeting and turn it over to the final tab, tab 8, adjustment update. All right, John and staff will conduct that, so it's all yours, John.
Thank you, Mr. Chairman. As you said, we're on tab 8, starting on slide 4, the economic environment. Already looked at many of these things. You've seen this slide repeatedly from me. Maybe a couple things I'd point out here, I guess, is, as it has been, sort of a mixed tale here, I guess, if you will. Some things are positive, some things a little less so. Certainly, we've seen some weakening in the metrics, which is certainly what the Federal Reserve has wanted as they've hiked rates. But I think the two standouts here that I would point out are sort of job growth and retail sales. Job growth has remained pretty darn strong. It's certainly come off the boil a little bit, but the unemployment rate still at an extremely low 3.5% relative to history is notable. And I think part of the reason why the economy, at least thus far, has held up well. Somewhat consistent with that is retail sales have been very strong. We've kind of been plugging along at modestly positive levels. We actually surprised pretty significantly to the upside here recently in July. Got print of up 1% month over month versus expectations of a 0.4. So the consumer seems to be strong still in this environment, which has kept, which is, I guess, fueled, as Jim was talking about, sort of the soft landing narrative that has somewhat taken hold in the market here most recently. So maybe moving to slide 5, you can see here the Federal Reserve interest rate in the red line. Huge increases we've talked about here over the last year and a half or so. It's certainly having the desired effect on inflation, as you see the blue line CPI coming down sharply. Although I would note that it, has not reached the Fed's target level of 2%. In fact, we saw a slight tick back up here in July for the kind of the first time in the downward trend to 3.2. So I think it still somewhat remains to be seen whether or not the Fed is entirely successful here as to whether they get that back down to levels that they would desire. Looking at slide 6, again, consistent with sort of the job narrative here, it's pretty interesting. So job openings and the quit rate, in other words, the rate at which people are voluntarily leaving their jobs, although that has come down, both of those metrics, as you can see to the far right, it is still well above levels prior to what we saw before any prior recession, which are the gray shaded lines there. So the past 3 cycles, we're nowhere near the levels that it would have been previously. So it seems like the job market remains strong. A lot of that, Wayne was asking earlier, I think is driven by demographics and what we see going on, kind of the baby boomer generation exiting the workforce and not necessarily the people to employ, coming along behind. So that may keep the economy moving along as well. Yeah, maybe.
So as the non-farmers, because the farmers never retire?
Yeah, probably.
Yes.
They would skew the data, is
That's
that?
right, that's right.
Interesting.
Slide 7, again, consistent kind of with the job story. Real earnings are kind of starting to tick back up. So, inflation is coming down, but wage growth continues to move along. And so, as that gets to a positive level, we'll have greater purchasing power. As Jim noted earlier, the damage is done to some degree from the inflation that we saw. But nonetheless, employees are getting wage gains, and that is probably part of the higher quit rate, as you can well imagine too. People leave a job because they can make more money going to some other job. That's probably one of the primary reasons that they're going to leave. slide 8, maybe the counterpoint to that narrative to a degree here is, you kind of ask yourself, well, why has the economy held up better than expectations when the Fed's raising interest rates and that's supposed to put a bite on things and slow everything down? I think maybe one of the reasons is that businesses and consumers are somewhat still enjoying the low rates that we had previously. In other words, their balance sheets haven't really taken the hit yet. So if you look at the chart on the left, corporations, their interest payment still remains very low because we talked about this repeatedly in past years, how the duration of the aggregate index was moving higher and higher. Corporations were terming their debt out. So if they had short-term debt, they're moving it out to 5, 10, 30 years because, why not when you're getting 2.5% rates on a 30-year or something like that. And so that damage hasn't happened because they haven't had to refinance. Jason talked about this a little bit with high yield. There's no maturity wall coming up. We probably won't see defaults because they don't have maturities out, most of them until 2027. You'll start to see the market react, let's say in 2025 or something. They'll be ahead of that, but it's still a ways down the road before a lot of these companies have to refinance. So perhaps some of that stress hasn't hit.
And you see that in the housing market too. There's lots of stories
Absolutely.
about folks that do not want to sell their home because they have a 3.9 mortgage. And if they were to buy something else, it would be a 7% mortgage.
Yep.
And so the existing homes for sale are tiny. And also the corollary to what John just said on the embedded lower interest rates that are still present and will be for a number of years. The corollary for that is the excess savings that the federal government pumped out during COVID. It is winding down and it's close to wound down, but there's still some out there that this excess bulge of money that was helicopter money that was just dumped on on individuals in the economy.
Well, I think
That's
you
the
see
slide
a
to the
lot of,
right.
you see a lot of people come out of the funds they got during COVID, reduce their operating debt. Okay, now they're borrowing, but the rate's so high, but they're now gonna have to start servicing the other loans that they got. And that could change things quite a bit. Because all of a sudden they're gonna have some outgo they're not used to.
Exactly.
And they haven't planned for it.
I just saw something on TV just the other day about farmers and ranchers. Because so many of them have variable lines of credit, they're paying huge amounts and they're gonna be more and more too because they don't have those fixed rates.
Well, line of credit is among the shortest of, corporate loans. And so it's at the front end of the yield curve. And so it's at the highest level because the yield curve is inverted. It's
Right,
really
farmers
expensive.
and ranchers have operating loans
Yeah.
that go on forever and ever and ever.
But they
Used to
roll
be-
over, right?
They go up every,
Yeah.
every month or every
Interest rate-
quarter. It's
interest rate
ridiculous, their
changes,
variable
yeah.
rates. So
Right.
to me, this is sad.
So they're just seeing we're just starting to see the impacts of that. So I think that, a lot of the recessionary talk, everybody was concerned about a recession a few months ago. Now we've moved to kind of Goldilocks scenario where it's smooth sailing and soft landing. I guess I'm a little skeptical because of these things. I think maybe the pain just hasn't been felt to some degree or another yet. We'll see. Some of those other factors may mitigate it and maybe we'll sail right through. I hope we do, but it gives me a little bit of pause at any rate.
So you got anything on credit card debt? Cause it seems to be taking off
It
pretty
has,
substantial.
I don't have numbers in front of me or anything, but it has certainly started to tick back up.
Cause it went down.
It went, so you'll see it here in the chart to the right to some degree, the debt service to
That blue line
disposable
is-
income, that
yep.
blue line, you can see the deep.
So that's included with
That's
mortgages.
the decline, yeah, well, that's the decline that we saw during COVID when all the stimulus payments went out, so everybody paid that down, shored up their balance sheet. Now you're starting to see that tick back up again. And that, of course, is, gonna be a much higher interest rate too.
I think it's fair to say though that compared to the federal government, individuals in the US have a way stronger balance sheets and way more food. Just saying.
Well,
But when you take the
Just traded places.
wages not coming up, inflation been there, that's what's been picking that up. And how long can that be before something's gonna have to change?
So John, so
yes.
You would say that the markets have priced in a soft landing currently. They haven't adjusted to the potential.
I think it has, to a degree. I wouldn't necessarily say, all in or anything, but that is probably the predominant narrative right now, is more the soft landing narrative, that the Fed is going to be able to do that.
Okay, but there's some real alarming things that are going on right now, like increasing debt and that sort of thing.
Yeah.
Can you remind me which time the Fed engineered a soft landing?
Never.
Yeah, never. So, but there's gotta be a first time, Dan. There's gotta be a first time, so. Hope springs eternal, right?
Yeah.
They've never been successful at it. Why do we think it's gonna work now, right?
Because they're due. They're due.
Okay.
That's an investment strategy.
I hope we don't follow that one.
All right, moving on to slide 9, assets under management by asset class. Nothing really, changed, no major changes here to say, but happy to answer questions.
John, could I interject that? There were 2 pages in the RVK report that I didn't do because of time constraints imposed on me by the chair.
So you're still doing them anyway?
Doing them on my time.
But I wrote it down in my speaking notes. This is the Dan Villa, John Putnam Memorial pages, because they are the Board of Investment's list of funds that you're now responsible for is growing like topsy. Dan, can't you do something about that? And in all seriousness, the Board of Investment structure is a great one because you get a group of people focused on investment. But guess what? It also tends to attract, like gravity, every fund that happens to pop up, regardless of size and purpose. We're seeing that in Florida, we're seeing it in West Virginia, we're seeing it in Wisconsin, and we're seeing it here, we're seeing it in Oregon. All the Board of Investment structures. So
2 things. One, can it be the commemorative instead of the memorial? And 2, it's not only gonna be the funds, but the services behind those. So literally, while we've been sitting here today, DNRC called to see if we would be interested in servicing their loan portfolio. So we're going to see some concentration and consolidation of function in addition to funds.
And 3, that's called job security.
That's right.
But is your point, by bringing more and more funds in, it dilutes your ability for your long-term strategy, doesn't it?
no, not necessarily, but what it does do is it strains the back office. Am I not? I mean, it really does.
Personnel.
The second is that these are all your customers. So both the Dan staff as well as the investment staff have to spend some time with your customers, right? Because you're managing their money. And you also have to understand their liabilities, just like the state fund, you've got to understand what they're up to. And eventually, as this goes on, some of the funds have liabilities that are simply different and distinct, just like the state fund's asset allocation is different than the pension plans. And so there's added complexity to the board's job and to John and Dan's job. Is that a reasonable summary?
I would say yes, it's a reasonable summary, but I would say it's a net benefit for the people of Montana.
Oh,
We can get some of these smaller communities into funds that they would never be able to get access to. The real estate funds we've got, private equity. If we're able to get people into trust fund, they're just not going to be able to purchase those assets either as an entity themselves or as an individual local government. So I view it as a net positive that we're getting people exposures to new asset classes that frankly in this state are only going to be available through us.
Or at
But
least they can't get
the other thing, personnel wise, okay, you're restricted by what the legislature granted you during the session, so you got 2 years basically before you can get more personnel, okay? If, let's just say the management stuff could be put into enterprise fund, can you hire there, or are you still restricted there?
So I always like to keep an FTE or 2 laying around, whether it's for succession planning or ready to go. Like I mentioned yesterday in the orientation, we're going to have to bulk up in privates at some point. We have the FTE to do that. If I get really desperate, I can call the budget office and get a modified FTE and then ask for that permanently down the road. But at this point, I think and the other thing we're doing is we're automating, right? Like this project with the accounting system, I want our financial statement prep to go from 3 months of staff time to several weeks of staff time. That'll free up some capacity on that back office side.
State of Illinois recently forced all of the local fire districts that each had their own pension to combine into a state plan. Now, given that Illinois has had some issues with their pensions, we'll see how it turns out, but it's exactly, they are forming kind of a board of investment for fire districts.
We're not following the state of Illinois, sorry.
That was not an RVK recommendation, although we have clients in the state of Illinois, I'll have you know.
All right, slide 10, assets under management by participant type. Again, nothing really to call out here in terms of any major changes. Slide 11, growth in the pools. We've talked about this many times before as well, and I think we already noted it at some point here, but STIP likely to start to shrink some as income tax rebates, property tax rebates, and many other things go out the door. And Kirsten and the rest of the fixed income team is doing a great job of making sure we have liquidity and communication with all of those different entities so that we perform flawlessly within STIP. Slide 12, pension, the asset allocation, first and foremost, of course, within all of the approved ranges. A couple of additional points here. As of the end of the fiscal year, cash is probably a bit lower than it was throughout the course of the quarter because we let it run down because we knew that we had some cash infusions coming in early July, most notably the $96 million in the public safety funds that the legislature gave to us. So that rolled in early July as well as a few other things. So that, cash had probably been running more like 2.5. It's more like 3 as of today.
When you say cash, that includes STIP?
STIP, so STIP basically. Current numbers, just kind of high level. Talking to Jim a minute ago, we've been rotating somewhat out of some of the public equities because of some of the dynamics that Jim was talking about. Domestic equity in particular being pretty expensive, had a great run into the end of the fiscal year, that continued into July. But also because when I look at the asset allocation, we've been, slightly below the midpoint within core fixed income and non-core fixed income because we were there prior, kind of interest rates going up and avoiding that. Well, now we're getting a pretty good return. I don't know if the Fed is done or not, but the equation has certainly changed. Felt like we wanted to, put a little more into fixed income as we're getting paid there. So it brought those up, reduced public equities a little bit. So we're probably, call it 2% below the midpoint in domestic equities, maybe 1 in international, and kind of got core and non-core back close to the midpoint at this point just because of those dynamics. And of course, I can't affect the illiquid asset allocation portions, the private equity, real estate, et cetera. And so those are kind of the levers that you're left with. Slide 13 is just, the dollar representation of that, but yeah, I have to answer questions.
So because they're above the midpoint, so that'll slow down our investing in those areas, and John, I mean, are you?
So you'll recall, we kind of have pacing. So roughly we're trying to allocate similar amounts each year. And we don't want to change that too drastically at any given point in time because, you never know when there's going to be a good or a bad vintage year when you're investing in these areas. That said, that's probably pretty true, say, in the private equity, private investment space, in real estate as an example here, and maybe real assets to a degree. you'll recall some of the funds that we're putting money into are separate accounts. So they're permanent funds. So we don't have that rolling pacing where, you know, it's a 10-year fund and you're getting your money back and then you got to put it in the next fund, kind of in there. So there, we won't have that kind of a dynamic. So we may slow pacing down a little bit to a degree, but it's more because of the characteristics of what we're investing in rather than a reaction to, oh, we're not way over our skis or anything. We are a little above the midpoint in both of those areas, but that's at least partly driven by, you know, kind of other factors in the portfolio that can't control what the price is of something at a given point in time.
You always have things in the pipeline, so.
There's always things in the pipeline. So, you know, we will never, so anecdotally, you know, at a few meetings I have talked to some peers, there is a problem in the market in some areas within some of those categories where some peers are way out over their skis and they are, in some cases, stopping investing completely. And we think that is the wrong approach.
The history of doing that is very bad. During the GFC, when equities came way down, many parts of the fixed income arena went way down. By definition, the percentage of the portfolio that was in privates and illiquids went way up. Many investors said, oh, we can't tolerate this. We're just going to stop investing in privates for 2 or 3 years. Well, it turned out that those 2 or 3 years were some of the best vintage years ever. And that's the danger. You walk a fine line of trying to balance between maintaining pacing in vintage year without over-investing simply because you're not paying attention.
Mark, did you have a question? Or good? So moving on to slide 14. Pension net performance, so a nice bounce back this year from the prior fiscal year, but as I'm always talking about, you know, want you really to be looking more at the 5 and 10-year returns. That's really what is most significant, and you know, I think it's a nice thing to point out, at least, that if we look at the 10-year return, the dollar value add, you know, basically doubled over the course of that time frame. We paid about a third of that out in benefits, but you know, we increased the overall size of the pension portfolio by 5.6 billion. So that's, you know, kind of thing we would hope to continue over the long term. Slide 15, you know, just again would note good long-term performance in excess of our actuarial hurdle across all time frames here, and that is ultimately the goal of the pensions. So. Good news. Slide 16, just a breakdown of our largest clients or groups of clients here. Again, nothing really notable, I don't think, to point out different from prior quarters. In the STIP portfolio on slide 17, diversified across the various STIP sectors as always, and as we've been talking about, the weighted average maturity of the portfolio went down from, I think it was about 62 days in Q1 down to 57 days here for the reasons that we've already talked about.
So has it been trending down for a while, or?
Yeah, I would say it has been, yeah.
So are you still adding to the reserve?
We are still adding to the reserve. So right now, the reserve is about 83 basis points of the STIP portfolio. And so you'll remember that the cap for the reserve is 1.15. We're inside that 3-year window. We'll probably, you know, as we've talked about, STIP will come down. So we'll probably might get there sooner as the total valuation in STIP comes down. You know, maybe we'll get that cap sooner rather than later. See how much actually comes out.
I got a question going back to 14 when I think of it. Sure. When we're looking at the payouts versus the earnings and stuff with the actuarial estimates, what rate of return do we need in these pension funds in order to not have to go into principal?
Yeah, so payout varies kind of from year to year a little
Yeah.
bit, and it has been increasing a bit. And we
Yeah,
talked
baby
earlier
boomer.
about when you hit that baby boomer point in 4 or 5 years, you start to roll over. But right now, it's been running between, let's say, 3 and 4%, probably about 3.5.
What's their prediction though for like, say, 10 years out? And how much would be paid out? I mean, what rate of return do they need in those actual studies in order to sustain it?
In order to keep principal stable, essentially?
Because they're 70% funded and some of those is where my concerns are.
Right, yeah, if we hit that 3.5%.
As long as we're above that, we're
As long as
okay.
we're above that. And, and so in any given year, of course,
They're gonna have.
maybe we don't hit it, but hopefully we hit it.
But our 8% returns then we're well above
Yes,
what it takes.
absolutely.
Okay, that's what I was wondering.
Well, and our assumed rate of return is 7.3.
7.3. So 7.3.
That's what you guys are based on?
That's the
Right.
assumed.
So
actual
7.3 would pay off, we'd be 100% funded and inside of 30 years, depends on the
35 or
pension fund.
Just keep in mind that
For
your
us.
benefit payments rise, you're chasing a rabbit here, so that, you can't look at it with a static set of numbers because,
But that's where you got your actual studies are telling you what you gotta achieve.
And Dwayne, that's part of where I'd say a legislative misunderstanding takes place every session, that they think that this liability is due today and that we're just pushing this debt out. Well, a lot of that debt hasn't even been accrued because we haven't even hired the employee who's gonna retire in 25 years and start drawing a benefit. So trying to educate legislators as to why there's a 30-year amortization and why these things are there. You wanna talk about chasing a rabbit? There it is.
Well, and as long as state government keeps growing, you've got more money coming in.
As long as state government exists, there'll be a public pension system. And as long as we don't burn corpus and we don't start seeing those funded ratios and the amortization windows
That's
go
what
the
my
wrong way,
concern was, yep.
we're in a good place. Now, they decided this session that they were gonna take some of the surplus and pay off all of the above 30-year, above 7.3% for the public safety pensions. Great. We took that money, put it to work in the, as Jason said, the preferreds, EMD, the rest. I think over the next session, at least PERS will ask for some small contribution increases like they have in prior sessions. I mean, Jim, I think most states would kill to be where we're at with our pension system. So,
yeah, the only thing I would add to what you said is that state government doesn't even have to grow in terms of number of employees, just salaries have to grow.
Yeah.
Right.
But if you had a decline in that type of thing, you change and privatize stuff or whatever, that's where the concern would be, is that's when it come home to roost.
And I wouldn't say it's just a misunderstanding with state legislatures. That's a common misunderstanding across the whole population, everybody, even very well-versed, intelligent people in regards to pension funding and what that actually means.
we should have a conversation about how to pay it off earlier through wage growth.
You'd like that.
No one? Gee.
It may be late in the day, but we're
Yeah,
not.
absolutely.
That was the sound of a lead balloon
That
hitting.
was exactly right.
But where everybody's concern comes from is you read financial statements on local entities and they got 5 pages on the doggone pension plan, and how underfunded it is. That's where people sit there and wonder, where are we at?
Yep.
That's a common question,
All right, STIP performance on slide 18. Fixed income team already kind of touched on it, I think. So, high level here is basically STIP yields have been going up because the Fed's been raising rates, and the current yield is right about 5.4%, I think, as Kristen said earlier. Yay. Trust funds investment pool on slide 19, sorry. Main thing, well, a couple things. So we're inside of our asset allocation ranges, of course. You will see real assets here for the first time on this slide as we had our first drawdown for one of our commitments, and clearly that will grow over time as we have a few other things in the pipeline, but good to see that starting to take shape at any rate. Slide 20. Again, trust fund net performance. I won't spend a lot of time here since they did a good job with their presentation, but if you look at the bottom there, that distributable book yield, one that says yield at the bottom there, you can see the 1-year number starting to tick up a little bit, and hopefully if we have a consistent environment here, we'll continue to see that grow as we're able to reinvest at higher levels. Slide 21, state fund. Again, within all of our policy ranges here, we don't have any capital called yet for real assets, but we do have a couple of things, 2, 3 things that are kind of in the pipeline, either for future approval or one that's actually been approved but hasn't called any capital yet. I did speak with their finance and audit committee in June, just after our May meeting, kind of our usual annual report, and it went very well. I think our relationship with State Fund is on much better footing than it had been in the past. I believe they were happy with us. John Ramasco met with them yesterday. I wasn't able to join since we were doing board training for Dwayne, but he said that went well also, and a good conversation with them. We've got kind of quarterly updates set up with them at this point. And certainly we'd be happy to talk to them anytime when they pick up the phone and call us. Yeah, Mark.
So you're at the top of the range on the real estate.
Yeah.
So what is there?
So these are all, remember, core real estate funds. They're the open-ended core real estate funds. We have some redemption requests in the queue. We would like that to come down more like 6%. I am not hopeful that that happens anytime real soon. The core funds have been slow.
Let it float up to where you just let it float wherever it's at.
Well, we don't, we are actively trying to take some money off the table there, but we're not in control of that necessarily. We have the redemption request in. How much we get back is a function of that fund. Again, we'd like to get that down a little bit, but.
So is that specific to the state fund portfolio, or is that across the board?
It's across the board.
Yeah, okay.
We've got redemption requests in for pension, trust fund, and state fund, to varying degrees depending on what they're trying to do.
So if they don't come through, would you potentially come back to the board and ask to expand that?
Probably not. So
Because like we were just
you
talking
may
about.
recall, I think it was in February this year, maybe December or something, we actually breached the range here in state fund just slightly. We were like 8.1. In the policy, it allows for us to breach ranges as long as I come and report to you why and what we're going to do about it. And the answer at that time was, well, we're not going to do anything other than, keep trying to get our money back for these redemption requests. But, we've talked plenty about the real estate market, and it's starting to break loose, I'd say, a little bit in terms of transactions, but it's still, not what it was. And that ultimately, they've got to sell buildings and things to get money back to us. And so, when that happens, we will get it.
Are we still waiting for valuations to come down? I think Ethan talked about it, at least in the office space, like a 25% impairment. Have we seen?
Yeah, I think, and Ethan will certainly talk about this more. We have certainly seen some of that. I think there is probably more to go, particularly in office space, although all office space is not created equal either. There are certainly significant differences. Medical office, maybe as an example, is probably doing pretty well versus, central business districts, and particularly even in some cities. So maybe New York Central Business District doing okay, San Francisco not. It's very much in line with the real estate, mantra of location, location, location. So, still a work in progress, Dan, for sure. Would expect additional lower marks, but, very dependent on sector and location. State fund portfolio transition is going well. We talked about a bit, continuing to kind of push up duration there, consistent with the change in benchmarks. will add some real asset exposure, and ultimately, to Mark's question, we will get probably some converts done there, but that's sort of third on the list of things to do in terms of the changes that we made at the February meeting, so a ways to go yet on some of that. State fund performance on slide 22, good performance across all the timeframes relative to our benchmarks there. Nothing really else, I guess, to say about that, but happy to take other questions on state fund. All right, finally, for me anyways, slide 23. So I think the market believes that the Fed is near the end of their hiking cycle. If you go look at the Fed futures screen, market's baking in less than one additional hike from here. We'll kind of see what happens, I guess. Public equities, when I wrote this, it was probably more true than it is today, but you know, we were seeing throughout July, you know, continued excitement, I guess I would say, particularly around the tech space and AI. Jim mentioned NVIDIA. They're sort of one of the firms apparently that's going to provide a lot of the hardware that's going to allow all that to run. So, you know, we'll see. We've come off of the boil a little bit here in the last month or so. I'm a bit cautious, and as I've kind of indicated, a bit skeptical of kind of the Goldilocks narrative. And I think the big thing here is really just that the risk reward has changed so substantially for the fixed income assets. We actually get a yield there. In some instances, as Jason was talking about in non-core, it's a yield. If you're thinking about fixed income in terms of you usually get paid the yield over time, that's what you're going to realize in terms of your return. If we're getting an 8% yield in most of those strategies or better, that's above our actuarial return hurdle. That looks pretty good, so we should probably, you know, have some money there. Sec lending, we moved to a separate account with State Street. So very high level quickly, not to go too deep in the weeds, but remember, securities lending is run by our custodian. So that is when they take the securities that they hold for us and loan them out to people. So if somebody wants to short a stock, for instance, they would borrow that security from us, for instance. State Street would manage that process. One of the ways they would do that is they have to post collateral of some sort. In many instances, they would post cash collateral. So they would give us the value of that security. We would invest that cash in a money market fund type vehicle. State Street would do that for us. And then when they return our security, we give them back our cash, but we keep the interest that we made on that cash over that time period. That's how we get paid. In the past, we have been in a commingled vehicle, so with all the other clients for State Street, and probably only Jack remembers some of the things that we went through the financial crisis when they had some issues in that account because they had some securities that were less than stellar. And it took us a long time to kind of work through that, and we didn't really have much control because we're tied up with all the other clients. So we have our own account. We control both to some degree, you know, what they can put in that account. In other words, what's the riskiness of that? So we have modeled it for them best we can because we have to work within their processes on STIP, essentially, similar parameters. And then if we ever do have an issue, we control the narrative. We decide we want to sell out of something or do something there to fix a problem. It's all in our control. We don't have to worry about what any other clients are doing. So that's the reasoning high level.
So you have a separate account with State Street
for this sec lending cash
collateral. You still have separate accounts for your clients. I mean, like state fund, right? So
yes. So everybody, all the accounts that we have participate in sec lending, but if a security is borrowed, it is attributed to, for instance, state fund. So it's okay, state fund owns this security, they're going to get that sec lending revenue, not pension. So yes, those are all segregated, or even if it's, you know, even to the very small separate accounts that might have, you know, a couple of treasuries or something. So absolutely, yeah.
Just a quick example of a problem that might arise is that credit issue for some
Well,
of the
so
water
during,
security?
so during the GFC, you know, it's a money market fund, they had things in there that we would have not put in a cash account, CDOs, SIVs, various things that ran into trouble and defaulted in some cases. One of them that comes to mind is they had like a Goldman Sachs mortgage-backed security on, subprime loans that, under almost no scenario was this thing ever gonna pay off. And it was, and they also.
We wouldn't have the cash to give back when the security came back.
Correct, that's right. They couldn't sell those, they would have had to sell those securities for a loss, and then they don't have the cash to give back to the person that borrowed. Exactly right.
That's a big improvement, and I think it's all.
Yeah, I mean, I had to deal with a lot of that, so I well remember those problems. So I'm happy to have a different arrangement with them. And they were very accommodating. John Ramasco and I went out and did an onsite with their whole asset management and sec lending team and kind of kicked the tires before we got comfortable that we wanted to go down this path. So a lot of due diligence on that. Next one, we have hired Colmore to provide a fee validation service for us for our private real estate, real asset managers. So this is a third-party validation service for fees. So they're kind of like, think of them like a CEM, I guess, if you will, where they're going maybe even deeper, I guess. They're going out, they're coming to us, we give them a list of managers and we give them our legal documents. Here's how the waterfall works for this private equity fund. Here's all the cash flows. They work with State Street, and they go back and do an audit, I guess, if you will, and confirm that, the fees that we should be charged are the fees that we actually were charged. I would say, and Jim, correct me if I'm wrong, these guys have been around, or this type of service has probably been around, I'm gonna say about 5 years that it's started to catch on a bit. I don't think it's industry standard by any means, but it certainly makes a lot of sense to us, and I think to me seems like probably a best practice thing. We wanna be ahead of the curve here. We're already the most audited entity in state government, so hey, what's one more? This is sort of a trial run, so we've signed up for 25 managers, sort of a sampling methodology, I guess, if you will, similar to an audit. You don't pull everything, you pull a sampling, and so we're gonna try it with 25 managers. We think it will work well, and if it goes well, I think maybe we expand over time.
Yeah, I agree with John that this is a relatively new development for several reasons. One is because public plans which live in glass houses are increasing their private exposure, number one. Number two is a lot of the state legislatures or other jurisdictions like counties and cities are requiring fee transparency reports from folks like yourselves. And they're hard to do. We were hired by a $28 billion LA fund to do 60 of these, and it pretty much broke us. I mean, these are brutal. When you have a 10-year history for a fund, you're going through every cash flow, every time they deducted a management fee, how they calculated the waterfall, and whether they calculated the hurdle correctly for the. I mean, it is a lot of sweat equity. So I'm not surprised that there's a bit of a cottage industry growing here, and I think it will grow. I don't know Colmore, but actually I'd like to know more about them. Would you mind if we gave them a call just to find out what they're up to?
Sure.
Thanks.
So what
Aaron's
happens
the expert.
What happens if you find issues?
We go back to the manager. So that part of their pitch
Then
is.
you gotta invest more time
Well,
in this.
they'll go back for us essentially, because they're gonna have a relationship with them at that point. But we would go back and say, we think you overcharged us or whatever, and give it back.
So wouldn't it
That part of their pitch is that they say that this will pay for itself, that they will find some things and that it will pay for itself.
Too
So
soon
we'll
to
see.
tell?
Too soon to,
Way too
we
soon
have,
to
yeah,
start.
we have just
If
started.
they find that we were undercharged, do they just keep that under their head?
Yes,
Yes.
and if they don't, they're fired.
Okay, but it sounds to me like.
They're private equity managers. I find it hard to believe that we would ever be
Right,
undercharged,
yeah.
so.
Probably never happened.
This sounds like, to me, like you're on the bleeding edge of this rather than.
I wouldn't say bleeding
best-
edge. They're
best
they're
practice.
pretty well, it's an established service, but I don't think, I would be virtually certain that the majority of public pensions are not doing this, but there are some. I mean, so it's not like we're
I
the first.
agree. You're on the cutting edge here, for better or worse, we'll find out.
We'll find out.
So could this also lead to a simplification or a better fee structure system in these regards, or?
That's out, that's the.
I don't, I
They're
wouldn't
just gonna
foresee, I
validate,
wouldn't
they're not
foresee
gonna make
that.
recommendations, right? They're just gonna validate.
I wouldn't foresee that.
Interesting.
I don't think it's gonna change fees or fee structures, but it's going to put managers on their toes to make sure that they do it correctly. I will say that in the 60 that we did, we only found 2 or 3 anomalies, which that was less than we expected to find. But we're not gonna take on another assignment like that again. Never again. We're not in the audit business, different business.
All right, last couple points here, promoted Rob Sampson to level 2 investment analyst at the end of June. So remember, Rob was our intern, summer of 2020, and then went to a family office. We got him back. Been very happy with Rob. He's passed all 3 levels of the CFA, and he's actually just waiting for his work experience, which he'll get in November or so, and then he'll have his charter. So just wanted to report that out. And then asset allocation meeting with RBK at the beginning of the month here went very, very well. Jim blew us off and went hiking in the Alps, but you know.
You had to say that.
Oh, wow. But it was good. It was
He's
good.
never gonna let me
I know.
forget
Throw-
that.
He's right here.
And Jim,
He's
did
in
you notice
Montana.
it went well without you?
Yeah, I did actually. Becky reminded me, and then so did Paige.
But yeah, great discussion, and I'll be coming with my asset allocation recommendation in October. So happy to answer any other questions. If not, I'll turn it over to Aaron.
Good afternoon, Chair, members of the board. I will focus on the key takeaways tab, page for macro attribution on page 24. What I'd point out is this is the first time I've shown you a 3-year attribution, whereas typically I've shown you a 1-year. The purpose being that we believe that longer time period reduces the noise that you'll see in those shorter term timeframes. That being said, if anybody wants to see that the shorter term 1-year attributions, we can certainly do that offline at some point. So jumping right into it, beginning with strategic asset allocation or the performance of our midpoint weighted benchmark portfolio, what would we have earned if we were invested in our asset class benchmarks at the midpoint weights? We would have roughly earned approximately 8.4%, with the core fixed income benchmark being the only asset class benchmark that didn't add any value over that 3-year period, which is of course not surprising given the rise in interest rates. Moving on to tactical asset allocation, which measures that additional return that our actual asset allocation weights would have earned from the midpoint weights. And that would have just been a modest 15 basis point increase in return. So 2 important points I think to make there. First, your CIO, John, has the ability to underweight or overweight these asset classes within the ranges that you approve each year. During this period of attribution, we rebalance fairly regularly to the midpoint weights. So there was not a lot of active weights that we were taking during this period. That being said, if he decides to take more active positions, it will certainly show up in this analysis, and you'll be able to see it. And I'm sure we can discuss it if that ever happens. Second, some of the overweighting and underweighting positions are structural in nature. So when an asset class is moving very quickly,
it's not feasible for us to rebalance it daily. We'll do it periodically throughout the month or more if necessary. But that can be some of the cause of these small little contributions. And as we discussed a little bit earlier, with private asset classes, we can't really rebalance to whatever their midpoints are. We don't control the calls or the distributions from our GPs. Moving on to style selection, for international, I would just quickly point out that we have a slight growth benchmark bias. So the benchmarks that our managers have in aggregate has a slight growth bias versus the asset class benchmark, and that produced a small underperformance of about 7 basis points. The real assets portfolio, its asset class benchmark consists of about 33% TIPS, 33% infrastructure, and 33% of the commodities benchmark. Our actual portfolio has about 54% commodities, so that roughly 21% overweight in commodities led to about an outperformance of about 16 basis points. Moving on to manager selection, I think the only thing I'd really point out here is that the private asset classes are doing what we expect them to do over the longer term timeframes. If you look at private investments or real assets or real estate, they all have modest excess contributions. So in these longer timeframes, we know they're not going to be really large or really negative, or at least we don't think they will be. If you remember to any of the previous attributions I've shown, especially with private investments, I mean, there could have been like a 3% excess attribution or negative or positive. So this is really where we're reducing that noise. That's all I have. Any questions?
Just a comment that this is, your staff does more internally on macro attribution than almost any of our other clients. We have a module that does this as well, very similarly structured. I'm sure Aaron has seen it. This is very good, but, and maybe it's a topic that we might want to discuss during the board visit. As Aaron's comments point out, the shorter the time frame, the more you need to understand what's driving it, because it's kind of like looking at quarterly returns. They don't have a lot of information and it can be very misleading. On the other hand, the attribution math gets weaker and weaker the longer the period. If you were to do 10 years, it wouldn't be very, because it doesn't capture cash flows and changes in asset allocation very well. So there's a sweet spot, but what's better is to take periods like Aaron has done here, which is an excellent job, and do them in kind of rolling blocks and get used to seeing them. And what you're going to see is a pattern, not unlike what you see here. You're going to see strategic asset allocation dominate everything else in terms of driving your returns, and by the way, your risk too. And during periods of time when the public markets go down and the private markets lag, you're going to see a lot of manager selection contribution from your private managers, and it's going to reverse when the situation reverses, when public markets go way up and your privates tend to lag. So this is something you want to learn how to interpret, but tip of the hat to Aaron and your staff, really good job.
That's off to Jason. Thank you.
And you're gonna run away on that one, no?
Drop the mic and walk out.
Yeah. Yeah.
I thought you were done.
It's me again. I always have in my notes, wait for applause when I approach the podium, but it never seems to happen. But I'll remind you that we talked about non-core fixed income earlier, so that's more something. But we'll dive right into domestic equity on page 27. A lot of this has already been discussed in terms of what is driving the market, very concentrated rally, these mega cap growth stocks. That has been somewhat of a drag for relative returns for the pension portfolio, given that we are modestly overweight small caps. So you'll see that in the track record. But moving to page 28, again, we are all passive investments in domestic equity or indexed as another term, that we are tracking, trying to track the index, not trying to outperform the index. But that doesn't mean, as we mentioned, that we talked a little bit before, it doesn't mean that there are ways that we can be active. We can adjust our allocation to domestic equities, which I think John might have talked about. It explains a little bit of where we are currently in terms of our position versus the midpoint, as well as our ability to adjust our weight to small cap versus large cap, and we've maintained pretty consistent overweight to small cap recently. Page 29 valuations, you talked about that, and not much to add. I did go look, so the top 10 of the S&P 500, top 10 stocks are 32% of the index. They contribute 22% of the earnings. So it's a little bit indicative of valuations and where the market is. It's an interesting aspect there. And two, what you see here is the chart. This is the market multiple. It doesn't necessarily tell you all about what's within. RBK had some interesting slides about NVIDIA trading at over 200 times. The spread between the highest valuation companies and the lowest PE companies is at a historical very high level. And so I don't think that's a surprise given what we talked about. Any questions about domestic equity? Like I said, I know we talked a little bit, quite a bit about the dynamics. I got here. International equities on page 30. Solid returns. We spoke to, they've been lagging U.S. stocks. There have been similar dynamics in terms of growth outperforming value, large cap outperforming small cap. That's been by a much smaller degree than we've seen in the United States. Really, the underperformance of international stocks has come from the performance of emerging market equities, which if you look at developed market equities, that returns for the last year have really been in line with those of U.S. stocks. And two, lastly, since our returns are in US dollars, currency has been a slight headwind, at least year to date. Page 31 shows the characteristics and exposures. Again, we are neutral in our positioning in developed markets versus emerging markets. This is not something we actively manage. This is really the sum result of our managers' decisions of how they allocate their portfolios. In the bottom left-hand corner, you see we do have a modest overweight to small caps. That's been pretty consistent. Bottom right, we have a little more active than passive. If you remember, in last quarter, we did add to active management. So before that change, that addition to active, these numbers about flip-flopped. So we had a little more passive than active. Now we've switched that to slightly more active than passive.
Look at the, on page 31, that excellent comment that he made about the spread on page 28 between information technology, where those mega stocks reside, how big that spread is in terms of PE. It is sizable in the international market, but it's nowhere near as dramatic as it is in the US market. This is largely a US market phenomenon, not entirely, but largely.
Yeah, and I kind of skipped over on page 28. If you go back, you look at the percent of the benchmark in tech. This looked very different even just 4 years ago. The amount of percent of tech in the major equity indexes has increased substantially. And that has, tech has increased somewhat in international, but not nearly the amount that we've seen in those. Page 32, short story is that valuations for international stocks have risen this year, but they're still below the 20-year average. And as we've noted before, they still trade at a historically large discount to US stocks. Typically, The average discount has been maybe 15-16% to US stocks. Now it's about double that. It's closer to 32 to 33%. One thing I didn't show here, but it's interesting too, the level of dividends compared in international equities compared to US stocks. You know, when I was talking about non-core fixed income, talking about capital appreciation versus income-oriented strategies. Now, stocks are considered, you know, we're looking for return enhancement, we're looking for capital appreciation, but some stocks do pay dividends. And the difference in dividend levels of international stocks versus US is at like a 2 standard deviation level. So a very, very high level of international stocks paying much higher dividend rate than US have historically.
Why do you think that is?
Valuations. So valuation goes up. And two, if you have large cap tech stocks, a lot of these may not pay a dividend. So that's another reason for a difference. As your stock price goes up and you're paying out the same level, then your dividend rate will decline actually.
I think most of it is valuation driving that. And it is stark, and it creates an asset allocation conundrum for John and staff, because even in our own capital market assumptions, if you just were driven by pure analysis, the kind of analysis that he's showing you, you would say, oh, we should be, from a return-seeking perspective or from a cash flow perspective, we should be overweight international stocks. And our CMAs are, because they're driven by analytics, are modestly higher than US, just because the numbers push us that way. But when you get to actually doing asset allocation, this is where judgment comes in. All these stocks in the international world, except maybe for Hong Kong, are not in dollars, and all your benefits are in dollars. So that's one. Two is there's this issue of event risk. The US is considered safe haven, all things considered. So there are reasons why, even if the analysis would say, from an asset allocation point of view, we need to push more into international, you might want to either curb that or not even go there to anywhere near the degree. But you can't ignore it. What he's telling you is exactly right. We're seeing it in our own capital markets analysis as well.
Any other questions about international equity? So moving on to non-core fixed income, I don't think there's anything I want to add. Besides, only thing I would add is some of the market dynamics. So year to date, lower quality credits have outperformed higher quality. So CCC high yield bonds have outperformed single B and double Bs. That typically is a difficult environment for our managers to outperform in. And I talked about the conservative bias that our managers have. And if the riskiest part of the segment of high yield is outperforming, then that's likely a headwind for our active managers. But outside of that, I don't see anything I want to call
That's
attention
part of the answer to question that somebody asked John about, is a soft landing priced in? That's a little piece of the answer. If CCC's, the most risky part of the high yield market, are outperforming, that's a sign that there's optimism. Priced in is too strong a term, but that there's a reflection of optimism that the default cycle won't be so bad. Otherwise, CCC's would not perform like this.
And two, I mentioned, if you turn to page 35, I spoke about high yield spreads in the presentation earlier, although I didn't have a graph of it, which you can see here. You can see some of the history of this is for just for the high yield market. Again, the spread is the incremental yield. So if you look at Treasury, comparable Treasury, which for high yield will probably be about a 5-year Treasury, and then the incremental yield to get to the absolute yield. I mentioned high yield is a little bit over 8% yields. And we've gotten there not from just high yield seeming more risky. That it's not come from just a really widening of spreads, but we've got two from the amount that's increased from the Treasury yields. So spreads, like I said, are pretty much a normal range, nothing out of an outlier that it's not severely overvalued market or one that's like indicating extreme stress, as you can see some of these times in the past on this chart where spreads have blown out. But just thought I'd add that. And two, I know I covered a lot during the presentation. If anything, any other questions that came to mind that you want me to follow up on, I'd answer those questions too. But given, like I said, it was an area that you're likely less familiar with, and we covered a lot in a pretty short amount of time. And, got pretty complicated in some areas pretty quickly, but be glad to answer any of the questions that you might have that lingering from the presentation.
This board does not linger.
Questions might linger. Apparently they're not, but thank you.
Thank you.
Mr. Chairman, members of the board. Member Iverson, welcome. I'm Ethan Hurley. I'm going to be covering off real estate on page 37. Here we go. So in the upper left is a pictorial representation of real estate asset allocation among the various entities. To the right, you'll see dollar value add for each of those respective entities through time. And down below that, we have performance. A lot to talk about in real estate. I threw a couple of bullet points in there for you. Main takeaway is things are still kind of dislocated. Credit's tight, transaction volumes are down. Prices have been adjusting downward. There's still a mispricing of assets between buyer and seller expectations. As such, while I think the price decline has been stabilizing and flattening out, and cap rates are beginning to show signs of stabilization, I would expect to continue to see some write-downs within the portfolio, at least for the next quarter, maybe two. We'll see. The appraisal process is fairly lagged, but the appraisals are catching up to what is being reflected in what transactions are occurring. And if you look at the public markets as a leading indicator of what's happening in the private markets, that spread is narrowing, and actual valuations in the private markets are starting to catch up, but it's going to take a few more quarters, I would expect. Are there any questions I can address?
In general, in real estate, I think our underwriting has been more conservative than others. So real estate is long-term. When we're able to judge our underwriting in this period, when can we do that?
Honestly, Jack, I'm not sure I understand your question.
Well, I'm trying to figure out how our underwriting is gonna handle this real estate
downturn. Sure.
And so, and in real estate, I understand that everything's long-term.
You bet.
So my question was, how long until we can understand how our portfolio is done? Is it another 5-year term, or what is it?
Has done through this specific period?
Yes.
That is an exercise in forecasting, which I'm not sure I'm capable or erudite enough to prognosticate on. That said, and maybe this addresses your question, we are privileged in that we have a perpetual investment horizon. And by virtue of that, we do not time markets. We invest fairly consistently, and we have invested capital quite consistently with managers we have done deep dives on, and have serially outperformed throughout cycles, and have invested capital on our behalf through this downturn. So arguably, as prices have declined, in my personal opinion is that's the right thing to do, and we will likely outperform and continue to do better than at our actuarial rate of return. If that is helpful.
Yeah, that's all I need.
Sort of my best shot.
Well, that's good.
Okay, great, thank you. Any other
I
questions?
was trying to get you to be a little more optimistic.
I mean, look, I think we've
Was.
placed a fair amount of capital over the last 18 months with managers that we have a lot of confidence in, that have great track records through cycles, which gives me a lot of confidence that we will do well through time, for sure.
Okay, don't get carried away.
Okay. Other questions? Okay. Page 38, upper left-hand corner, we are within our stated ranges. On the right is our property type diversification. Maybe I'll just address office. It's out there. We are underweight relative to any benchmark, though I don't pay a whole lot of attention to benchmarks. To one of John's earlier comments, all office is not created equal. Within that office allocation is medical office, which has done very well. We have some life science in there, which has done very well. The rest of it certainly is a mixture of CBD office, commodity, suburban office. Really, office is kind of a tale of two stories. One which is structurally adjusting, the other is outperforming and seeing rents that are well in excess of office rents that were pre-pandemic levels. So it's really about location, location, location. It even goes down to the micro level of, the actual tenants and work from home and bringing their workforce back. And Rob will talk more about some of our office exposure and why we're not running from office entirely when he talks about one of our recent commitments. Questions on page 38?
So on the office in central business district, there's I'm reading some conversion of those into living spaces.
You bet.
All of a sudden they become part of our apartment complex.
It may, in certain instances. I would anticipate we will see little of that in our actual office exposure.
I think it's gonna be a big play.
Agreed.
People
Agreed.
Just trying to figure out how to raise their revenue.
Yeah, and just it's a higher and better use, but even in and of itself, at the micro level, it gets super complicated when you think about the expense. You think about floor plates, you think about the need for additional plumbing if you're converting it into a multifamily apartment building, for example. It's a pretty complex transition, which, every office isn't necessarily, doesn't fit the mold, if you will. And so even in spite of some of the municipal laws that are being changed and the effort to tackle this problem, not every office building is created equally and is optimal for that conversion. Other questions? If not, I'll take you to page 39. Maybe I'll just draw your attention to the top table, sort of middle column, past month. To my point, prices seem to be stabilizing. And then on the far right, just bring your attention to how divergent the price adjustment has been among the various property types. It's just a good representation. If there are no questions, I will turn it over to Rob, my partner in crime, and he will take you through Oak Street Real Estate Capital Fund 6, our most recent real estate fund commitment. Thank you.
Chairman, members of the board, good to be here today. My name is Rob Sampson. I will briefly try to keep it quick today, take you through Oak Street Real Estate Fund 6, which on June 29th, we committed $50 million to. As you'll see, this is our third fund investment with this particular firm. Both the previous two, Fund 4 and Fund 5, have done very well thus far. As far as the firm is concerned, their culture, in addition to their investment strategy, their fantastic reputation in the market, and their consistency in making monthly distributions that are actually in excess of our actual rate of return, make them a manager that we continue to hold in very high regard. As far as Fund 6 itself is concerned, it has standard market terms, and it's going to continue to employ the consistent strategy that the firm rather has used throughout its entire life. This is focused on acquiring single-tenant, operationally essential assets in the retail, industrial, and mission-critical office spaces, and then triple net leasing those assets to high-quality, stable investment-grade tenants. Are there any questions?
Okay, now explain what you just said.
So essentially, they, in short, they have very good relationships with high-quality businesses that.
Could you do a couple examples?
Yes. So I think a good example is, say, actually, I'll default to a good example, actually, I think would be, say, Walgreens. So, for example, Walgreens or another investment grade company out there, they might talk to these companies, and Walgreens would talk to them about ways that they need capital. So instead of going out and raising debt, because we all have talked about a lot today how costly the debt market is, or issuing more equity and going through that rigmarole, they might actually talk to Oak Street rather and opt to sell some of their buildings. And this would fall into the retail category, and then access capital that way to expand growth. And so this follows, I'll kind of go back here to the retail, industrial, and mission critical office spaces. The way they think about office is headquarters, critical regional hubs, support centers, things that without those, the company really wouldn't be able to exist.
And this is North America.
North America, yes.
But, Dan, are we to say it? They're only looking for a 2% rent escalation. You're shooting for 3%.
I'm very mean when it comes to your money.
All right, well, hearing no more questions, I'll hand it back to Ethan to go over the real assets portfolio.
All right, I'm on page 41. Again, upper left-hand corner, the real assets asset allocation amongst the various entities. On the right is the dollar value add across various time periods with performance below. Lots we can talk about within the real assets portfolio. I'll just note that the top bullet point, global demand for oil has reached a new high. As such, we continue to focus on energy, specifically oil and gas, but broadly across the whole energy spectrum, and specifically and almost entirely on what makes sense and what's a good opportunity to make money. Housing's been slow, construction starts are down, utilization in rail is up, rates are up, construction materials demand is down, but prices continue to go up. It's a wonderful asset class. Aggregates have just gone up and to the right for over 50 years. I think there's 3 years during the last 55 where they've been depressed and they've fallen by less than 2%. It's pretty remarkable. Happy to address any questions. Seeing none, we'll just flip to the next page. Very similar layout here. We're within our strategic bands. On the right, you have our domestic and international breakdown. I might just say that, or continue to lead you into the idea that international will continue to expand more than likely, just given current dry powder and the other types of commitments we're looking at. Down below is our sort of capital activity in the private real assets part of the portfolio through time. Happy to address any specific questions. Seeing none, on page 43, these are the two sort of valuation metrics that I've chosen to show you. Crude has been relatively range bound over the last handful of months. It has ticked up recently given some of the thoughts around a soft landing here in the US with continued OPEC cuts, Russia continuing to be sanctioned. Lumber has retraced back to its pre-pandemic lows or sort of pricing. If any of you all would like to see other pricing or valuation metrics with regard to anything else within our portfolio, I'd be happy to put those in, or I'll just continue to put these in and talk to you about that stuff, or, you know, answer questions ad hoc. If there are questions, please let me know. Otherwise, we'll keep rolling and I'll transition this over to my colleague Thomas, and he can take it through private investments.
Ethan, you say that lumber prices are up slightly.
Yeah, they ticked up.
Quite a downtrend.
I mean, so real recently, Maggie, this is like second quarter. Yeah, so very much a downtrend, yes, for sure. Definitely from, yeah, the pandemic, we saw all-time highs. It was extremely volatile. It has since dropped off dramatically as we worked through some supply, and, you know, housing's been depressed, construction starts are down. Yeah.
Ethan, could I ask a question back on real estate? And I apologize for not asking it then. And that is, Howard Marks has often counseled us that, you know, the most important, maybe the risk is permanent loss of capital. And we see the occasional story these days of real estate managers handing the keys back to a bank for a given property. What's the trigger that typically causes a real estate manager to take such a drastic action? And have any occurred in the managers that are in the portfolio today?
So we have not had any evidence within our portfolio of managers handing the keys back.
There's your positive.
Yeah.
There have been some fund extensions and some loan extensions. There haven't been any equity cures yet within the portfolio, meaning the manager puts more equity in the deal to potentially refinance some higher interest rates in order to meet particular loan to value covenants. But to Jim's first question, and I'm assuming this is for your benefit because I know Jim knows the answer to this question, but people hand the keys back when they essentially default on their loans and can't service them properly and don't want to throw what they perceive to be good money after bad. And they, in their risk assessment, have priced in a permanent value decline, write down, and it doesn't make sense for them to put good money into that deal because even if they did, they wouldn't recover the value.
The good money being new equity or continued interest payments.
That's correct. That's correct. And one of the very prominent covenants within loan documents since the GFC has been non-recourse. So there is no, they just give the keys back to the banker and make it the banker's issue. And there's no recourse back to the manager, back to the fund. The loan officer simply has to take literally the keys back, the title, the deed, and they take ownership of the property. It's a foreclosure, and they'll ultimately try to manage it themselves, sell it off to somebody at a deep discount. There's a multitude of sort of strategies around that. There is talk that distress won't be as bad as people perceive it to be, but we'll see. I mean, there's talk of this maturity wall. There's been talk of that maturity wall since the GFC, so it has been present for the last 10 or 15 years. It's always going to be there. Capital markets always find a way to refinance, and there hasn't been major dislocation in the real estate market since the GFC. Most of what I perceive happening in the market in terms of value declines is driven by the increase in cap rates and has very little to do with actual fundamentals. Occupancies are still relatively high. Rents have come down, but they're coming down to normal levels, not the excess levels that they had been at during the pandemic and so forth. So still fairly healthy with the on-the-ground metrics. Cap rates are just adjusting given the interest rate environmentally. Thank you all.
Thank you. Jim, members of the board. Thomas Winkler, Director of Private Markets, Private Investments, I should say, excuse me. Good afternoon.
driving this home relatively quickly. There's no new commitments in the asset class, so I wanna skip that slide in the end, but I'll be on page 45. Just a quick ownership breakdown of the private investments in the portfolio. Keep in mind, we're in the pension plan only, in the cap. And we're investing in buyout and capital and private credit in this asset class, currently about $2.5 billion, or 17.5% or so of cap, lower than our IPS limits. The performance table, or the table that you see at the bottom, I always like to highlight the 5-year, 10-year plus type timeframes, as Aaron has made some comments. We're dealing with lagging valuations inherent to this asset class, so anything less than really 10 years is not very meaningful. On a 10-year basis, we're up 13%, 13.3%, so well ahead of our actual rate of return. Very proud of the performance that we've achieved in the portfolio. If there are any questions on this particular slide, I move on to page 46. Characteristics of the portfolio. Again, top left, you see we are within all of our bounds and ranges for the sub-asset classes. The little pie chart on the right-hand side gives you that breakdown. We like to add venture capital and buyout together in an equity bucket, if you will, and then we have private credit allocation. Nothing changes here dramatically quarter to quarter. I just wanted to highlight that we have increased private credit from about 19 or 20% about 2 years ago to now almost 24. Again, a reflection of some of the comments that John has made earlier. Yield environments, credit environments is actually an attractive area for us to invest even in the private space. So we have edged that up a little bit, but well within the bounds. The donut chart at the bottom there, domestic US versus international. The US allocation here has actually also come up over the last year, which was a little bit surprising, but we do look outside the US for opportunities, and we expect to make a few commitments there outside of the US. We do have a 30% limit, so we're well below that, but we certainly look opportunistically outside the US. Any questions on that particular slide? I move to page 47. Valuations in this asset class is a little bit tricky. We don't have mark-to-marks, we don't have daily valued indices, so it's a little bit trickier to make a good judgment call here. So what we do is we look at deal activity over the year, specifically in the buyout markets, and we can see here, it's a little bit shocking. So that last 2023 bar, that keep in mind that's only 6 months, so that's only half of the year to date. We are slightly behind deal activity, deal volume over the last couple of years, but still well ahead of the pre-COVID kind of setup. So deal activity is on track to probably give us exactly what we saw in 2019. The deals that are getting done are certainly a little bit more high quality. They're smaller, more digestible, and that leads back to the, again, comments that have been made earlier. Simply the cost of capital in the asset class has increased with interest rates going up. So managers are a little bit more selective. How much leverage are they putting on these deals? And the lenders, as well, as we saw some issues in the banking sector, they have become more conservative, more risk. Leverage definitely has come down, which leads me to the chart on the right-hand side. The blue bars, that is our debt multiple on buyout deals. That is clearly slightly below the long-term average, currently at 5.4 times leverage on a deal. Wanted to highlight here again to some of the comments Jack has made on the real estate portfolio. We do underwrite our managers also on a fairly conservative level. So across our portfolio, you'll see debt levels more in the 2 to 4 times versus 5. So we are taking that into consideration. If that's going to work out in the long term, I certainly hope so, but just know that we tend to be a little bit more conservative when it comes to leverage in these deals. Any particular questions on valuation slide? Seeing none, I mentioned page 48. I'll basically just highlight we are on track. This is our fiscal year to date. New commitments, you don't see any new commitments here. We did 7 commitments last fiscal year to date. That is within the range of 6 to 8. What we're trying to do, 400 to 500 million per year. We ended the fiscal year 6/30 at 405 million, so right within the range. And more to come on new commitments in October. Any other follow-ups, comments, questions? I'll hand it over to John Romasco. Thank you.
Thank you, Thomas. Members of the board, if I could refer you to slide 49. You'll see there that the core internal managed funds, about 13.5 billion, not quite half of the assets that the board has. Looking at performance, you can see some negative numbers there, again, driven by increased interest rates. Kirsten showed you the teeter-totter. We were unfortunately on the downside of that teeter-totter this time, so a little bit of negative rates there. Decent performance relative to the benchmark. That's because we started the year short duration or lower risk for interest rate changes. The state fund, you'll note, has a positive number and a little stronger outperformance. The reason for that is we had the old intermediate index when we started the year. We switched during the year to the longer aggregate index, and so state fund was short duration and performed relatively better. Last thing on that slide that I would note is STIP increasing yields slightly below the benchmark. You would always expect STIP to underperform the benchmark in increasing rate environments because it has a slight duration, but still a duration, whereas the benchmark does not. If I could look at slide 50, couple of things to note. Kind of hard to see this on the right-hand side of that upper slide, but corporate spreads came in a little bit over the year. Not much change in mortgages, so risk product did well on the year. The fascinating lower slide, we in fixed income are just fascinated by this, but it's been done to death, so we won't talk about the inversion of the yield curve anymore. Going on to slide 51, the characteristics of the pension. So you'll see the duration at the end of the year was about 105% of the index. We started the year about 96% of the index. So fairly significant move in an effort to extend duration and lock in higher rates. You'll note a significant difference from the index in contribution to duration from corporate, which is think of that as the corporate risk metric. At the end of the year, we were about 73% of the index. That is because we've always felt that the fixed income portfolio in the pension pool provides a counterpoint to equity risk. And so I expect John has in fact moved money during the year, out of equity and into fixed income. I fully expect that should equities sell off or underperform, John will come down and say, "Hey, Slim, how about some money?" Which I think is maybe hurtful, but he will do it. And so
enjoy it.
Yeah, and it seems to. So it wouldn't make sense if we had risked up that portfolio just when John needs the money to offset risk somewhere else. So we kind of have a handshake deal that neutral for that portfolio is 75% contribution to duration from corporates. And you'll note we're a little short of that. No bet on risk there. It just was simply that new money came in it diluted, the increased denominator diluted the existing corporate. We chose to use that money to extend duration, and so we'll catch up to neutral for corporates in fairly short order. Going on to characteristics for trust fund, all that is similar stories there, except for the contribution to duration from corporate is more neutral to the index. Finally, looking at state fund, you'll see our duration is still short at 85%. We started the year at 65%, so a pretty dramatic move to lengthen that index. And happy to take any questions. Thank you.
Thank you, John. So we did a pretty good job covering all that stuff. Do you have anything else, John?
I do not.
Okay, so the next thing we gotta do is recap of staff to do stuff. Did we give Dan any work to do?
There must be something.
We'll find some, I mean, you know.
We'll make some.
Something to look at calendar-wise, if October 23rd, 24th works for our board conversation. Yep. Looking at some form of formalizing fiduciary training within the work plan on a biannual basis. And then a self-report, we'll call it. I neglected to talk about this in tab 2. There is a draft state pay plan released from the Department of Administration. As you may know, we have our professional growth plan within BOI. We spent a lot of time on it. It's individualized for every employee in every position. New Mexico Investment Council has copied it since I was able to poach some employees from them potentially. But under the draft policy, our PGP would go away. We would be under one state pay plan, which there are no other accountants that do $32 billion in transactions a year except for ours. There are no investment analysts anywhere else in the state of Montana. So this is one that so your employees, the exempt employees, are not covered by this pay plan. The employees I supervise on your behalf are, so this is one I'm gonna go to the wall on, and I just wanted you to be aware.
Go to the wall to maintain.
To maintain our PGP the way we've developed it for our employees.
And how do we support you in that?
If you see anyone at the Blackfoot that you could whisper in an ear to, that would be helpful. I'm hopeful that there is sort of a common sense prevailing attitude about this of some of the agencies are not like the rest of the agencies. If the worst case is, I'll come to you and say, we need to make the entire organization exempt from the pay plan, like the exempt staff are, like state fund is, like legislative branch. That's a worst case.
I agree with everything you're saying. But we're different than everybody else is something that they hear from every other agency.
Exactly. Exactly. It's, the point I'm going to emphasize is we had problems recruiting staff. We don't now. We're able, with the internship program we've built, with the PGP we've built, you can see in the interview, and it comes up in every interview, and I think it's been contributory to our recruitment and retention. Here's how you can grow your professional self. Here's how you can grow your income. And it's not one of those time and seats type pay plans. It's you will gain these knowledge, skills, and abilities, and then as your contributions increase, your compensation will increase. It's not I hit 5 years, so I get a raise. That's what we actively wanted to avoid.
But, okay, so this overall general pay plan thing. Where specifically is that coming from?
It's from the Department of Administration.
Okay.
Just a comment that I'm pretty sure, in fact, we've been just retained by a Western state to go over their investment staff compensation, and they have several investment staffs. They don't have a Bureau of Investment Structure. And do a review and incentive compensation review and so on. But there are three categories of state employees in my experience, both working in state government and also working with state boards of investment as well as pension plans and so on. And they are investment staffs, increasingly so, that have their own separate pay structure, that for all the reasons that Dan said. Usually doctors, and oftentimes lead attorneys in the general counsel's office. Those three categories.
Our accountants or any of our staff, non-executive,
Oh, the football
are they
coach.
unionized?
Yeah, football.
Are they unionized?
We have no union staff, no.
That's a really good thing. I mean,
So not,
That's not on the
not
record, is
even the people that are classified?
No, our classified staff are
They're
not
not
represented.
union.
it makes it easier to do it, I
And
guess.
part of that is because we stay, if you have happy employees, they don't need to be represented. Although now that they're all listening on the TV, they're all,
Well, that's-
Eric Burke's calling them already, Putnam.
My point was,
Yeah.
if you don't have a contract that says you have to do it a certain way, it gives us more flexibility and the ability to fight administration to.
So I just wanted to self-report that one, that this is what I'm going in on.
Okay.
Otherwise, we'll meet Friday at 1 for any members of the loan committee who would like to be here or Zoom in to discuss that master loan agreement application.
This Friday?
This Friday at 1. If you want to be there, just let me know. I'll get you the Zoom invite. Otherwise, we will take care of it and coordinate with the chair on a subsequent meeting because it is over the $5 million threshold.
So we probably have to have a formal vote.
So do you want, is it just loan members that, committee members? I mean, why
Anybody,
can't
I mean,
you
as
invite
we always
everybody?
do, if you want to show, well, what I want to do is know how many are going to come. So if I get to a quorum, I can notice it today. But if I don't get to a quorum, I don't have to notice it.
I am out of town.
I won't be there.
I'm not coming, but you can Zoom it.
Yep. Okay, I'll Zoom you in.
And then in October, is the 23rd and 24th confirmed?
Does that not work for anyone?
That works for me.
Works for you,
That's-
Maggie?
It doesn't work for me, but I can make it work.
But
Okay.
we also have an October 11th.
Yeah, we do. So that
Right.
was my next
That's
question.
the next
We have
meeting is
both.
October 11th.
Yes,
You still do both?
Yeah,
we do
right.
both. Yep.
Okay.
Different.
All right,
Wait a
well,
second, so for that loan meeting, don't you need a quorum though?
This is a
Not
work
me.
session.
Well, it's just a work session.
Just to understand it, because I think there is a very real possibility that we don't even bring it to loan committee.
Is this the,
The hospitals, the one that was pulled from the agenda today,
okay. And what time would you do that?
1 o'clock on Friday.
good. All right, meeting adjourned.
Thank you.
Thank you